chapter 8, dollar value LIFO, back on page 436, 437. This is kind of obscure stuff, but it gets tested on the CPA exam, and there are, of course, companies that are still using this kind of inventory method. But most schools don't bother to have the students learn it. So then, when you guys take the CPA exam, you get the points and they don't. This is fine. We'll take that. Right? Thank you. It also gets you to think a lot. And I like it for that reason. It gets you to crank through some allocations, some analysis, I suppose. And it gets you comfortable working with inflation, adjusting for changes in purchasing power. So we've got this dollar value LIFO thing. All right. You guys know what? Oh, by the way, in this chapter, we're doing dollar value LIFO at the end. When you get into chapter 9, we are going to have retail dollar value LIFO, which is just a mess, because we're going to have retail inventory methods. What retail is going to be is, I value my inventory at my retail sales price. You know, when you go to Walmart, all their product is sitting there in the bins, and the retail price is on the bin, right? The cost is not. So if you have people to count your inventory, could they count it and write down the retail price for you? Absolutely, right? So you do all the inventory to retail, and then you compute what it would be at cost, approximation of what it would be at cost. So people that are, now obviously Walmart wouldn't do that because Walmart has everything in the computer and then, perpetual. But if you're periodic, this might work really well, huh? Right? So imagine a mom and pop store that might do that kind of thing. So there are environments where you use these things, okay? But anyway, what's LIFO? Last in, first out. The ones you still have in inventory are the first ones you bought, right? The ones you sold are the most recent ones, which of course is not what we do, but it's for tax purposes, but we also must use it for financial statement purposes, right? Or we can't use it for tax purposes. In fact, it's kind of interesting. They talk about advantages and disadvantages. Isn't it right at the end of this chapter? Yeah, major advantages of LIFO and major disadvantages of LIFO. And then they have, over on page 445, that evolving issue, repeal LIFO. And it's not very evolving. People have been talking about this forever, right? So the death of LIFO, what would happen in terms of the tax that's due? $61 billion in extra tax collections as of January 2009. And they wrote that article. Right, inside that little beige box on page 445. Right? Well, really, you could repeal using LIFO for generally accepted accounting principles and still allow it for tax purposes. And that would make more sense, probably. It would be kind of disruptive to the economy right now if we made everybody pay all those back taxes. It'd be kind of a mess. But we'd have to phase it in somehow, and it's something, right? But every administration wants to collect those tax dollars, of course. $61 billion would be really nice, wouldn't it? Right, to help with the deficit, right? But Congress intended to put LIFO tax deduction in there because businesses that have inventory defer their taxes kind of indefinitely with LIFO, right? They major portion of taxes. Anyway, so all of my clients use LIFO. Of course they did. Would you pay taxes now or later? What would be your choice? Time value money? Later. So of course. But you got to be careful with LIFO too, because what you want to do is make sure that you keep the assets available to pay those taxes should they ever come due. I don't need cash in the bank. I just mean that you're liquid enough that you could do it, right? Because when do you have to pay the tax? When people no longer want to buy your product, right? And you're selling it as fast as you possibly can. When your product's becoming obsolete, and maybe your business has a downturn anyway. Got the idea? And now all of a sudden you have to pay all those taxes you didn't pay when you're probably not profitable, or maybe you're less profitable. Got the idea? So you want to make sure you hang on to it. So advise your clients, particularly if you're with smaller clients, right? Hey, you guys, yes, you want to use LIFO, and it's not forever. It's until you sell, until you deplete your inventory, right? If you get rid of an inventory item, you're going to pay all the tax related to the deferral on that one, right? So anyway, when they talk about LIFO liquidation. So what's dollar value LIFO? versus LIFO. LIFO is just you kept the old ones, right? Sold the new ones. But what's dollar value LIFO? They say they're on page 435 at the bottom. Overcomes the problem of redefining pools and eroding layers. This method determines and measures any increases or decreases in a pool in terms of total dollar value, not the physical quantity of the goods in the inventory pool. You don't have to keep track of all the layers of LIFO inventory. You just keep it in a pool by year. Okay? Imagine if you didn't have a computer, how nice this would be. Even if you do, it's kind of nice, right? So it's just an approximation of what LIFO would be. And we use these pools to do that. So dollar value is I'm not tracking the units, I'm tracking the dollars of inventory. Okay? That's what's going on. We're taking a look at page 435, dollar value LIFO. Okay, so here they've got an example. This should maybe run through that. Middle of page 436, they have a layer from the beginning inventory, and they say in terms of 100. Now what we mean is that's the base year. So an index of 100 means it's 100%, right? The inventory is 100% of the base year. Is that the base year dollars? And then each year going forward, we typically have inflation, right? Okay, so as the prices increase, you'll have an index reflects the price increase. So there's 5% inflation, it'll be 1.05. Make sense? Okay, and so they show you that. They say, I guess they're in 2014, the second year where they had some increase. By the way, this inflation is not overall inflation across the economy. It's inflation on your inventory, right? Your inventory items. So if they're a real hot commodity, they may be going up fast or slower than the inflation rate of the economy either way, right? Could be either one. Anyway, so there's a 20% price increase is what they're saying there, okay? So you can just look at what your suppliers are charging you in the base year and then what they're charging you each subsequent year, and you can get an idea, right, of what your index is. You can compute it. Take what the price is on your inventory average, in the base year and the price in the subsequent years, and look at the change and then divide it by the base year. So it's all based on the base year. That makes sense, guys?
So even years 2, 3, 4, you still go back to year 1.
To the year 1, to the beginning, yeah. So you keep a base year, and then occasionally you might change to a new base year, right? But probably not, actually. You just keep going until you deplete that inventory out. Okay? All right, so then you have layers that for each of these years then, based on the changes in the total inventory, but it's the change in the base year dollars. So we're comparing apples and apples. Because each year they cost more, right? So of course the dollars are more. So when you look at this comprehensive example on page 437, they show at December 31st, the base year they had inventory of 200,000. Of course it's 200,000 base year dollars because those are base year dollars. Okay. The next year in 2012 they have inventory of 299,000, but it costs $1.15 to buy what a dollar would have in the base year. Got the idea? So you divide the 1.15 into the 299, you get 260. That's what the inventory would have been in base year dollars. If I bought it in the base year, that's what it would have cost me. That's my estimate.
So for like 2012, they're saying that 260 is what it would have been in 2011?
Yep, what it would have cost in 2011. So then what I say is, okay, it's LIFO. So I keep the 200 from the first year, right? And I'm selling the new stuff, right? But I've added a layer of 60 in base year dollars. Then what I'll do is, so down below, they're going to show in the last box there, right on that page 437, they show the 260, they split in the 200 that's from the base year, right? 60 is a new layer for the new year for 2012. So I have a base year layer, 2011. It's 200 times 100%, of course, is 200 base year. And then the 60 increase in base year dollars, 2011 dollars, did cost me $1.15 each. Got the idea? Okay, 115% of the purchase price. So take 60 times 1.15 is 69. So the base year is still at 200, the old prices. The new layer is 69 at 2012 prices. Got it? And that's your inventory. And each year you can either add a new layer or you can deplete layers, right? If you deplete layers, you'll never have a layer for that year, right? It's only when you increase it. That makes sense? It's a real simple process. So look back up at the top, page 437. Each of them, they have deflated by the inflation rate, right? In 2013, they have 300, but now it costs $1.20 to buy what it would have cost in 2011 for $1, right? So that's 250. Now what happened that year is they dropped off 10,000, didn't they? What goes first? Base year dollars or more recent ones? The most recent ones go first. It's LIFO, right? Remember, it's LIFO always. So what we'll keep then is 200 at 100%, right? And we're only going to have 50 at 115%, and we're going to have none from 2013. There will not be a 2013 layer. Make sense? Because you dipped into the 2012 layer, you don't have a 213 layer, and you never will. Then the next year, when it goes up to 270, they took 351 and divided by 130, and they have inflation on this inventory item, right? You can do it across your whole inventory or by groups of inventory items, categories of inventory, each inventory item if you wanted, I suppose. Okay? But if you have a small inventory, you might do that, a small number of items. Okay, so what we'll do then in 2014, when you divide 351 by 130, it's 270. Well, now what do you have? You have 200,000 from the base year. You have 50,000 from 2012, right? Which will be inflated at 1.15, right? And then you're going to have another 20,000, but that's coming from 2014. And those will have cost you 130, okay? So as you flip through the next pages, that's what we do. There's your 2013, there's your base, and now what we have from 2012, it was 60 the year before, but we depleted 10 of it, so now we depleted 10 in base year dollars, right? So now it's down to 50, and so we take that at 115 times 1.15, and my inventory has gone down to 257.5 for that year. Then in illustration 825, middle of the page there, look what happens. I have the base year, I have the 2012, there's nothing from 2013, I never will have a layer from that year, right? And then I add 20 more to get up to the 270 in base, and that's at 130, and we're on our way. So now that that's perfectly clear, let's take a look before we go to a problem. Take a look at the top of page 439. They're saying select a price index. You can calculate this thing by doing what? Ending inventory for the period of current cost divided by the ending inventory of the period of base cost is the price index for the current year. So you can always do that, right? Okay. So really not much of a problem coming up this season.
So for 2012, that 50,000 is that additional from the 2,000,
60 less 10 that you sold off. 60 from the year before, right? Layer.
Right.
And you sold off 10 of it, right? Because we depleted our total inventory in base year dollars.
Right.
We actually have less physical inventory, we think, right? Base year dollars, if you got base against base, it must be how much inventory you really have, right?
Yeah.
You know, in quantity, but we don't know what the quantities are, but it represents quantity, doesn't it? So if it goes up, if it goes up, you have a new layer. If it goes down, you depleted a layer. That's all. Let's try. Let's do exercise 8. I don't know, 825. How do you go? You guys do that. See if you can do it just based on what we just said, and then we'll try to do it.
825.
Exercise 825. third year, of course. I think what I'd do is convert them each one into base year, and then just do year at a time. If you divide each of the year end by their price index, that'll get you back to the base year.
Right.
On the first one, obviously your inventory is just the base year, right? You got that one. The second one, you subtract what you have at base year for the second year. Take the base year from what you have for base price at the end of the second year. That's your new layer. Reinflate that, right? So take it back times the price index, and then add the two together. You got the inventory. Third year, so look at just the change from the second year to the third year. If it goes down, you have depleted part of the year before, right? Okay, if it's gone up, you have another base, you have another year, another layer. So each year could have a layer or not, depending on if you deplete it. If you deplete, there's no layer for that year, and there never will be. Okay? And of course, you could deplete clear down into the base year. When people did just-in-time inventories, where they were, had more inventory than they really needed, or, well, we found out they did, and they set up relationships with their suppliers to get the inventory to it really quickly. Like nowadays with UPS, FedEx, doing distribution for you, people's inventories are extremely low now, right? So when you would deplete LIFO layers, that was one of the problems. People have to pay a whole bunch of taxes because they have their inventory under control. So it's a trade-off. It looks really efficient, but you don't want to carry inventory you don't need, of course. You have inventory obsolescence problems, cost of carrying the inventory, interest, warehousing, moving it around, damaging it. Is that going good? You guys get stymied, but we'll do it together. When you feel stymied, do it together.
Then you just add all those differences up, right? So
Yeah, so you have 1 year, and then the next year, and then the next year, right? And so you keep them, and the next year you just add another one to those. Or you might deplete some of them, right? And once you deplete them, they're gone forever. Can't get them back. And you might add a next one the next year. So, yes. And always they're going to be in that particular year's index. It's the year you bought it, right? Determines its cost. And it sort of approximates LIFO, don't you think? Notre Dame hockey.
My cousin used to work up there in the
Oh,
athletic department, so
yeah.
get free shirts every
You
once
say
in a
you
while.
play hockey?
No,
No.
I play nothing.
My Frank Raymond teaches econ here as a hockey player. He still plays hockey.
Really?
In his 50s, still plays hockey. God, he's a crazy guy. Out there with all the young guys getting beat up.
My neighbor does that too. He's probably 55 actually.
Yeah. But Frank might be. I'm 65. Frank might be. Yeah. Anyway, yeah. He says it doesn't make you sore though if you're skating. The only thing that makes you sore is bruises and stuff.
Yeah.
It's not like if you were playing football or
Not that hard on your joints.
Yeah, it doesn't grab the joints.
Have you ever tried? It's tough.
I
There's a certain-
cannot stand up on skates. I'm so
Yeah.
uncoordinated. My ankles are real weak. I can't even do.
I can do it until they want you to go backwards.
And then over.
But I took a little bit in high school.
And those guys, unbelievable. Yeah.
Yeah.
Frank grew up in the Northeast. So,
Yeah.
in the snow country. My wife is a really good athlete. When she was in high school, before she got pregnant with our daughter, anyway, really my stepdaughter, which is my daughter. She got pregnant her senior year in high school. Before that, though, she played on the softball team. She said she got a home run 90% of the time.
Really?
Yeah, she was
That's
just,
like not even fair.
she was just a monster. Yeah, and she's not very big, and then she played first base, and so she can throw a baseball further than I can hit one. I'm scared. It's scary. We're out there with a softball, and she hurt my hand. She's out in the outfield. She hurt my hand throwing into the catcher's mitt. And holy crap! This is like when she's 21 and I'm 31. And what? Because we were trying to show my son how to play baseball a little bit, which he's not a great athlete either. Our daughter got her genes. She's a good athlete. The son was okay. He played football a bit. He's a good musician. Probably more valuable in the course of a lifetime to be a good musician than to be a good football player, I suppose. For most of us. Unless you're a really good football player. Unfortunately, my son's got my genetics. I'm coordinated, mostly. You want to do these?
Yeah.
Did you do them? Do you know me? Is it working?
I think I need to see it.
Okay, all right.
I think I got an answer, but I'm not sure.
Got an answer maybe? Okay. I think what I do is right away get the base on all of them, So we're doing 825. So we got 11, 12, 13, 14, 15, 16. Okay, so year end. Now this is year end, and you just have to kind of keep track of these. This is year end in that year end dollars. And then what we're going to want to compute, we're going to take the price index. This is all I just given to you, of course, and divide it in, and that's going to give us base, right? So, and obviously on the first one, it's 100, so we got 80,000 here. This is 100, so obviously divide by 100, take times 100. Don't do that. Just run it on across. It's 80, right? Okay. So for 12, we have 115.5. And then what you should have done is divide that by 105. What'd you get if you did that?
Oh, you divided by 105?
Oh, yeah. Bring it down to the base year.
110.
Yeah, thanks, is all right. Okay, anyway, so yeah, we're deflating it for the
Yeah,
inflation.
that makes sense now.
We went down to the base year, down to 100. Okay, so if you had 5% inflation, what we're asking is, what would it have cost us in the base year to buy that 115.5? If I divide 1.05 into it, I get back to what it would have cost the prior year. Yeah.
So what you want to do is divide out to get the base. And then
Yeah.
you're timesing the price index, or not
The increment, you're going to take it times the index.
Right.
To get down to the base, you divide it in.
Okay.
So first, what I'm going to do is I'm going to divide the 105 into the 115.5. What'd you get when you did that?
90,000.
I gave you guys such a great explanation, that's funny. You got to see it, right? It's got to see it. But it would have cost me 90 to buy that 115.5.
Yeah.
Oh, well,
Next.
scared everybody half to death. 110? Okay. That looks better for 105. It would have cost me 110 to buy right? That if I'd have bought it in 2011. Because it cost me $1.05 to buy what it cost me $1 the year before. That's all. Okay, so then what I'm going to do is I'm going to say, what's my increment? Okay, so what happened here? Okay, so I got year end, price index, base, and then the increment maybe. Okay, what happened? It went up by how much? 30,000. Now that 30,000 I bought this year, not last year, right? I bought it in 2012. So how much did those cost? 105% of base year dollars. So I first divide by the 105 and then take it times the 105. Times 1.05 is what? This is the new layer, right? 31,500. So what I would have then at 2011 is an 80,000 inventory, right? That's 2011, of course. That's the 2011 layer, the base layer. True? So now what I have the next year is the 80,000 plus the 31.5, huh? You guys with me on that? So at the end of the next year, it looks to me like I have 111.5, is that what that is?
Yeah.
Yeah. So that's so this is my 2011 layer, which is also my total inventory. This is my 2012 layer. And this is my 2012 in the inventory. Got it? And some of that is from 2011, 80,000, and some of it is from 2012, 31.5. Got it? And then we just keep rolling. Now the next,
Do you recommend we like keep totaling those up like at each year's?
oh, you just have to add a new layer, unless you deplete. If you deplete, now you got to take a chunk out.
So what I'm saying is like, so should you get that 111.5 number every time? Or should you just like?
Oh, you don't need to bother.
Okay.
If I add a new layer,
Yeah.
I'll have the 80 layer plus the 31.5 plus the new one.
Yeah, okay.
And I just keep going, right? But some years you'll deplete a layer, and what's going to happen is this, in the very next year, I think it goes down because it was 90, wasn't it? This 31.5 will go away, part of it, right? So you don't want to keep it then. But the 80 base isn't going to go away until we get down to 80. If we get less than 80, all the layers will go away if we get down to down below 80, right, guys? And we'll start dipping into that layer. So in 2013, what do we have? 108?
Yeah,
So they reduced their inventory some. The index is 120, so they reduced it a lot. And would you say that was 90,000? So if this one's 90,000, now what happened? Well, you have a negative 20,000 increment. What's that coming out of? Oh, that's wiping out part of the newest layer, right? Because it's LIFO, last in, first out. So what happened is this 30,000 layer, 20 of it's gone. What's left? Only 10,000 of it in base dollars, right? Times 105. And how much is that? You say 11.5?
Oh, I would,
10,000 times 1.05?
no, it's 10.5.
10.5.
Why can't you take 31.5 plus 20? Okay, gotcha.
Because
All
the
right.
31.5 is inflated. If you wanted, you could take 20 times 105, and you'd get 21,000, I guess. And then you take that away from 31.5, and you get the 10.5 that we're going to have here. I don't think I'd do it that way. It's risky, isn't it? Yeah. This one's gone. This is the new 2012 layer. Got it?
So what's the how do you get from the 20,000 to the 10,000, like the 10,000 from?
I had, these are base dollars, right? I have 30 in base dollars the increment, right? That's a base increment.
We've depleted 20, so it's.
And we depleted 20 of it, so there's 10 base left out of that layer. So out of the 2012 layer, I have 10 left, but I have to reinflate them at 105, right? Got it. And again, what we could have done is we could have taken 20 times 105, and that would have given us 21,000, I think. And then you take 31.5 less 21,000, you get the 10.5 still. That's fine. Some people do it that way, wouldn't they? The 20 I depleted was 20 at 105. So that's fine, but make sure you get apples and apples, right? 105 against 105, 100 against 100, whatever it is. Did I do it? So what's my inventory? This was the 2012 inventory. This was the 2011 inventory. What's my 2013 inventory? It's 11.5 plus 10.5, right? How much 111.5 plus 10.5? How much is that? It's the 2013 inventory. Well, it's going to go on my balance sheet. How much is it? 111.5 plus what's left of the 2012 layer. 2011 layer plus what's left of the 2012. There is no 2013 layer, right? We didn't add anything in 2013, right? So what's my 2013 inventory? 122,000. You guys good? You just keep going. So remember, the 13 is no layer now. So let's try 2014. What do we got? 122.2. 130. It cost me $1.30 to buy what $1 would have bought in my base year, 2011, right? So divide 1.3 into 122.2, and you find out what you would have spent in the base year to get that. How much is that? 94. So now you don't go back all the way to the 110 because we depleted, right? We depleted 20 of that. So you only go back to the 90. What happened compared to the year before? We have a new layer. How much is the new layer? 4,000. That's in base year dollars. So what do you need to do with it? Take it times the price index, 1.3 for that year, because that's when you bought it, right? So we inflated at 130, 130%, right? So 4,000 times 1.3 is how much for my 2014 layer. Got it? How much is that? 5,200. And now what you could do is you could just take the 2013 inventory and add that to it, couldn't you? If you don't deplete, if you increase, you can just add it.
Yeah.
But what it's going to consist of, what my 2014 ending inventory is going to consist of is 80,000 from the base year, right? Wait a minute, did I do that right? Yeah, 80,000 from the base year. Oh, we did our inventory wrong, you guys. we didn't ever deplete the 80,000 from the base year, and we added a layer, 80,000 plus 10.5. What did we do? The 111.5 is 80,000 plus 31.5. Then we would have 80,000 plus 10.5. Where did we get the 122?
That was the 115 plus, or 111.5 plus 10.
Yeah, well, this 111.5 included the whole 20,000. Oh my gosh. Believe that. Look, you guys, we still have 80 from the base year, right? You did have 31.5 from the second year, right, from 2012, which made a 111.5, but you got rid of 20 of that in base dollars, which left only 10.5. We have 80. This inventory is going to be 80,000 from the base year plus 10.5. Oh my gosh, I'm sorry. 10.5 from, so that base year was 2011. And from 2012, we have 10.5. Right, this is a layer from 10.5 from 2012. That one would be 90,500. Screwed you guys up royal. You see why?
Is the reason because it was depleted?
Yeah, you wiped out part of it. We wouldn't have 111.5 anymore. We got less inventory, right? There's less.
But instead of doing 80 plus 10.5, we would have been 111.5 and then take the 20 off.
And subtract 21,000 from it, right? 111.5 less 21,000 is 90,500. Yeah, we did the math right. We just grabbed the wrong number.
Just went the wrong way.
Yeah, really. Well, I grabbed 2012 inventory instead of getting the base year. Terrible. Okay, you guys see it? I'll blame my cold. Okay, yeah, that's awful. That's right. Do you see it though? What we're doing? So let's do the next one. What are we going to have in the next year? What do we have left? We still have the 80,000 base, so let's do 2014, right? For 2014, we'll have 80,000 from the base year, which is 2011, right? What do we have from 2012? 10.5, right? Still there. And then what do we have from 2013? Trick question. What do we have in 2013? Nothing. There's no layer. What do we have from 2014? Better way to do it, probably. 5,200. That's our new layer. So what's our inventory? It'll be the 90,500, of course, 80,000 plus 10.5, plus the 5,200, right? So 5,200. So how much is that? 95,007? Okay. That making more sense? That'll be my year-end 2014 inventory. And it consists of 4 layers now. Got it? Now let's try 15. 154,000. 140. Divide 1.4 into 154, and what do you get? 110. How much did we add to the 94 base we had the year before? 16,000. What did those each cost us? 16,000 in base dollars, but it costs $1.40, right? For what a dollar would have cost. So 140% of 16 is what? 22.4. 22.4. And we're going to just keep going, right? So what's this? This is the layer for 2015. So what would we do to get 2015s? You know, you got these 3. 2011 layer 80,000, 2012 layer 10.5, 2014 layer 5,200, and then we're going to add the 22.4 for the 2015 layer. Got it? So you can just add it to what you have. If you don't deplete, you can just add it to your inventory, right? If you deplete, you got to redo it. So where are we at then? 95.7 plus 22.4 is what for our year in 2015?
118.1.
18,100. Okay.
Just to ask one more time, so when you deplete, make sure you leave out that year, so you don't do what we.
Yeah, you don't do what we did.
Right.
Yeah, wipe it out. Yeah. And we'll do it far enough. The next one looks like it depletes pretty good, doesn't it? Or does it? Well, maybe not. We'll add one if we have to. 176.9
122.
less 145 is 122. Oh crap. Okay, we're gonna have a lot of layers, aren't we? What's this gonna be? I don't know why they're building so much inventory. Oh, their sales are going way up, right? Maybe, right? So what's the deal? 12,000 more? Right? 122 less 110 times 145. How much is that for this layer?
17.4.
17. So that's going to be the layer for 2016. Okay, let's add it 2017. In 2017, we adopt just-in-time inventory. And what I have, so let's say the index is 150. Okay, we another 5% tacked on. Okay, it's 150, and let's say we get our inventory down to $140,000. Do it. I only have 140,000 year-end inventory. That's year-end prices. Everybody knows what that is, right? That's year-end dollars. What do we cost this year? Buy all of it. I got 140,000. The index is 150 compared to my base year. Things cost 50% more than they did in 2011. It's 2017. It's really interesting buying a car. Everybody says there's been no inflation. Car comparable to one my wife bought 10 years ago. Cost $10,000 more. It was 30, it's 40 now. It just is. And they said, well, yeah, but the sticker was 39 when you bought it for 30. Now the sticker is 41, and they'll sell it to you for 40. I mean, that's 10,000 inflation. Actually, it's not just inflation. The cars are popular. Everybody's buying cars back in the market because of the 2008 crash. People felt poor, now they feel rich, I guess. So what do you get when you take 140 and divide by 150? 93,333. Okay, what you got to do is get your layers. What layers do you have left? There's a whole bunch of layers here.
Take it from 2016 and some 2015.
I'll get rid of 2016 layer. How much did it go down by? Let's do that.
28,667.
28,667. Which ones are gone? This one's completely gone. 12. You guys agree with that? And then we need 16,667 more, don't we? This one's gone, isn't it? Well, it's pretty simple. What's left? That's 28. What's left?
67, so it'd be 30, it'd be 3333.
Yeah. This would be 3333, wouldn't it?
Yeah.
Isn't that right? That's it, isn't it? I have this layer left, and this layer left, and, 10 of this one, the base, right? Right? So what I have left is the base from 2011, which is 80,000, right? From 2012, right? I have how much? 2012 is 10.5, right? What's left? 2012 is 10,000 times 1.05, right, or 105 is how much? 10.5. That's that one I have left. Okay, that's got me up 80 plus 10 is 90, right? Then what do I need? 3,333 more, don't I? From 2014, there is no 13, right? From the 2014 layer, these are my layers, I would have 3,333. What's my index at that time? 1.3, right? You guys with me? This index of 105 is from year 12. We have nothing from year 13. We have the base year that's 100, and then we have some from 130, right? So 1.3 times 33333 is what?
Rounded to 4333.
What's my year-end inventory? 2017 year-end of financials. Did we do it right? You looking puzzled? Or
Yeah, no,
looks right?
I'm thinking, so, I was just starting to work, and I think doing more work by trying to just take the 28,667 and bring it back up and then remove.
Yeah, you can do either way, it'd be fine.
Yeah.
Yeah, either way.
So I just,
Yeah, I like to just chop them off and figure what I'd like.
yeah.
Yeah, so I can use the math I already did.
Yeah.
That's all.
Yeah, what I was starting to do is take the 118.1 and then add the 16 layer, which was the 17.4, and I was taking the 28.
Yeah.
Came up to like 43,000.
That's kind of complicated.
It's just extra work.
Yeah.
So,
You use the same point.
yeah.
Yeah. So what do those add up to? 94.
833.
Ta-da. So we could do this, couldn't we? They should have added that, something like that, but do a big deal. Okay? Dollar value life one. Worth doing. Thinking about it.
Seems like a lot of work.
Yeah. Yeah. But as compared to tracking 100,000 inventory items,
Yeah.
I think I might do this. Yeah. You bet. So, okay. You know, especially if I wasn't computerized. So, well, if I had 100,000 inventory items, I better be, you know, but even 1,000 inventory items, that's small business. Yeah. That's not really bad.
Are people actually doing this, or is most of it computerized for the most part?
Oh, some of both. There's still a lot of businesses out there that don't have the inventory computerized. If you're not on professional, if you're periodic, this would be a nice thing to do. So this allows people who are periodic to do LIFO without keeping track of layers. Nice, huh?
Yeah.
Yeah. So you get the tax benefit without doing detailed
Yeah, that's
work. Yeah. Maybe another good thing to do is to do some inventory errors. Those are always fun. Like exercise 810 and 811. Or 8.5 maybe. Let's start with these are all pretty good. Let's start with maybe exercise 810. This just feels more and more like having a job, doesn't it? Just gonna try to model for you guys. Oh man, I gotta go to work again. Learn how to do something. That's what work's gonna be too, is learning how to do stuff. Let's do exercise 810, maybe, inventory errors. You know, more and more this class is seeming like one of those flipped classrooms. You know what a flipped classroom is supposed to be? Is that you read and you watch, which reading is always been outside class. But then you watch videos outside of class, and then you come to class and you work on things that you don't already know, with groups usually, but, you know, I don't like working. I don't mind working in a team after I know how to do something, but like trying to learn it, I don't like that. That's just my personal preference. You guys can do whatever you want. Do you guys form teams? You work on stuff together? Groups of 2, 3, 4. Some classes do, some don't. Yes. Yeah, that's
I
fine.
mean, my roommate, we've had like, we're both accounting finance, so we have the same schedule.
Marathon stuff. So you said,
So
one guy's working on
do
something.
he'll be in the library, and I'm like, man, I'm gonna get so behind, I gotta get in there.
yeah, that's good. Cool. Yeah. So, you know, but then you can bounce stuff off of each other. It's kind of nice. Yeah. But I kind of like to do it after I already sort of know what I'm doing. And then fill in pieces versus learn from scratch. With it's too inefficient. The other thing is when I sit with the groups and work on stuff, they always want to cover stuff I already do. I want to cover stuff I don't know. You know, it's kind of like that, so. Okay, so, wait for, give me a couple guys. Wait for that. Let's take a look at 810, read through it. See what you think you do. Kind of basic. We did some of these in principles, but they go right over everybody's head. And here you need to really get it down. Well, there's another good one, exercise 812, nice one too. Okay, maybe we'll start with 812 before 810. Back to them. It's a little more straightforward. Okay, we thought we might do 812, or I thought we might do 812, I guess. This is similar to one I gave you in principles class, or somebody probably gave you in principles class, where you've got errors in the ending inventory, which causes net income to be screwed up. Could you calculate what net income should be in each one of the years? And the key thing to remember is an error in the ending inventory is going to be what? You're going to subtract that ending inventory from available, right? That's available to get your cost of goods sold. The next year, the error in the beginning inventory is going to be added to what's available when you calculate your cost of goods sold. So the error in one period is corrected in the next period. Always is, okay? And it just keeps flowing through. That still each year's income's wrong, right? But the error keeps getting corrected and corrected and corrected. So if you had a number of years, and at the beginning there's no error, and at the end of the year, at the end of the period there's no error, all the years added together in total are correct, right? Okay? So inventory is going to work that way. So that's the only thing that makes this at all difficult. So if you think about it, I've got all of my revenues less all of my expenses is my net income each year, right? Okay? And one of my expenses is cost of goods sold. So if you think about this, for each one of the years, if we just put 2009 to 2014 across here, 2009, 10, 11, 12, 13, and the last one was 14. Okay, whatever my revenues are, which I assume are okay, less all my expenses, which are not going to be okay, is going to be my net income, right? Okay, and then that net income is going to get close to retained earnings, right? So I could make this more difficult by saying, which I do in principles, probably will in here too, what's wrong with assets, liabilities, equity. So let's do the whole thing. What's wrong with my income statement, and then what's wrong with my assets, liability, and equity, okay? So let's do that for each one. Assets less my liabilities, right? Obviously, it's my equity. Do you agree with that? Assets less my liabilities is my equity. So we can do that too, or liabilities plus equity is assets, of course. Either way you want to do it. So I'm using a net assets approach here. Good. So let's figure out what the correct is going to be for each one, okay? Now, the key thing that we're gonna have then is in this expenses is cost of goods sold. And of course, any error we have in cost of goods sold is gonna be caused by the error we have in inventory, which is the error in the assets. But the error in cost of goods sold is gonna cause an error in what? Net income, right? It's gonna be the same error there. And that error in inventory, or the error in net income, however you wanna look at it, is gonna be the error you have in your equity. They're the same, right? Okay, so you can float through those. All right. So where does the error in cost of goods sold come from? If you do a cost of goods sold schedule, what do you have on it, everybody? Beginning inventory plus purchases is what? I don't know why it always looks like punch when I write it. Anyway, purchases, never get an R in there. Beginning inventory plus purchases is what? What do you call that? How much does it start with plus what I buy is what? What I buy plus what I start with plus what I buy is called available. You gotta take away ending to get cost of goods sold. Okay, so this is available. All right, and then we take away from that what? Ending inventory. Right, so ending inventory would be subtracted in every case. Am I right? That's all it is. You know that. You don't have to write all this down to work these problems, but I'm just getting it so you can see it. Okay. And then what does that give me in every single case, of course? Cost of goods sold. That's it. And that's what I want, of course, right? Cost of goods sold. That's the number I want, which is what's wrong up here. Okay? So let's go through them. The first year, it says net income per books is 50,000. Okay? So this is 50. I know that. Okay? The ending inventory is 3,000 overstated. What would you assume about the beginning inventory? It's okay. What would you assume about purchases? It's okay. What would you assume about available then? It's okay. They didn't say anything, so I'd assume it's okay. If 3,000 overstatement of ending inventory, this is too high by 3. I subtract too large a number by 3, what happened to my cost of goods sold? It's too low by 3. Cost of goods sold is too low by 3, which means my total expenses are too low by 3. If revenues are fine and my expenses are too low by 3, what's wrong with net income?
Overstated by 3.
It's too high by 3. Tell me the correct income. 47. And keys. What's wrong with my assets? The inventory account is what? No, the inventory account was overstated by 3. Right? Inventory is overstated by 3. What would be it, right? So it says. It's got to be the same error that we had in the cost of goods sold schedule, right? So if the inventory is overstated by 3, what about the liabilities? Is it the same thing was wrong with liabilities? No. So what must be wrong with equity? It's got to be overstated by 3. And why did that happen? Because you put 50 in net income into retained earnings, and it should have only been 47. Easy, isn't it? You think about it this way, you know all these relationships, you know how these statements fit together. Just relax and do it. By the way, we can mess with purchases. We can mess with beginning inventory, with ending inventory. We can mess with accounts payable. I failed to record a purchase. Should have debit to purchases, credit accounts payable, and I didn't do it. We can change any of these numbers, okay? Just relax and write down what you know, okay? Usually won't give you that many years. Okay, now the key thing is, did everybody see it so far? Yeah, pretty good. Okay, the key thing to think about then is, what does that ending inventory error 1 year do to the next year? What happens? The ending inventory of 1 year is by definition what? A millisecond later, the next year starts, and it's your beginning inventory. So if the ending inventory was too high by 3, what's wrong with the beginning of the next year? Too high by 3. If purchases are fine, what's wrong with available? Too high by 3. This gets easy, doesn't it? Okay, what's wrong with the ending?
It's overstated by 9.
Too high by 9. So you added 3 too much, and then you subtracted 9 too much. What's wrong? The 3 would have overstated cost of goods sold, but the 9 understates cost of goods sold, right? So it's 6 what? Too low. Right, guys? Isn't that 6 too low? 3 too high from adding to the beginning inventory too much. And 9 too low from subtracting on the ending inventory too much, right? Was overstated, wasn't it? Okay. Revenues are okay. So what's wrong with expenses? Too low by 6? Everybody agree? That's the cost of goods sold. Too low by 6 there. Okay? What does that mean to net income? It's too high by 6. You got it. And what was the net income that was reported? 52. What should it be? 46. I mean, we're really good, aren't we? We can just walk right through this crap. Okay. 2011. What would we do, everybody? That overstatement of 9 at the end of last year is a what? Overstatement in the beginning of 9. Add nothing to, or no error on the purchases, right? Gives me what? Available is going to be what? Too high by 9? You guys staying with me? It's true, isn't it? Okay. What about the ending inventory this time?
Understated by 11.
It's too low by 11. Now what's that going to do? Adding 9 too much to the beginning inventory is going to give you too much cost of goods sold. How about subtracting too little by 11? It's going to give you too much.
It's overstated by 2.
It's overstated by 20. Yeah, you got it. Okay? Not 2, 20.
Yeah.
9 overstated for adding too much to the beginning inventory plus 11, right? Overstated by subtracting too little, right? So if you write them down, it kind of works. You can use T accounts to do the same thing here and do it that way too. For, do a T account for inventory, look at what happened. It's fine. Okay, because you got cost of goods sold in the inventory, right? Versus in the inventory. Okay, so anyway, what do you have here? Too much cost of goods sold, too much cost of goods sold. By how much? 20? Right? Too much by 20. So your cost of goods sold is too high by 20. Did that right, didn't I? Too much for the 9 in the beginning plus too much because you subtracted too much. Yeah. Okay, so cost of goods sold is too much by 20. Revenues would be fine. So therefore, net income should be what?
More than sales, 74.
Too little, right? By 20. And what is it now? And what should it be? So wow, it looks like they have 50, 52, 54, gradually increasing income, and really it's 47, 46, 74. Stayed constant and went up. Are they smoothing? You know what smoothing is, right? Too much income one year, give it to the next year, too little, take it back, that kind of thing. Maybe. Oh, I didn't do the assets on the first one, but we could, right? Let's go ahead and do that. On 10, what would happen to the assets? What's wrong with inventory at the end?
Overstated by 6.
It's overstated by 6, which must mean what? Liabilities are fine, so what's wrong with equity?
By 6.
Over by 6. Now this gets a little more complex. How is it over by 6? How did that work? The error from the prior year fixed itself, didn't it? Is it 6? Ending inventory. Yeah, it's too low by 6. No, it's not. It's 9. You guys lied to me.
Yeah.
It's 9. I was going to say, that doesn't work. It's not 6. It's 9. Whoops, I should have left that one there. I think it's 6.
Wow.
It's 9.
Look it up and write it down.
Yeah, it's this one. 9. So the ending inventory is too high by 9, which means equity must be too high by 9. Wait a minute. How'd that work? Okay, let's think about equity, guys. Retained earnings, right? Equity. What did we do the first year? We overstated income by 3, and therefore our equity was too high by 3. You guys agree with that? What happened the second year? we overstated income by 6, right? 3 and 6. What does that give me in total? 9. There we go. So the inventory is too high by 9 and the equity is too high by 9. We're there. Okay. What do we have for the third year? What happens this time? I think that my net income was too high by 20. So what do I need to do this year? Reduce my net income. I thought my net income was too low by 20. I'm sorry. I thought it was too low by 20. So I'm going to increase my net income. Did I do that right? 3 too high in net income. Yeah, it was too high. This is overstated. This is overstated. This is overstated, right? So what are we going to do the next year? I think my net income is understated by 20, right? So I'm going to, it's 20 too low, it's understated. I'm going to have to increase it, in other words, okay? So where am I at now? What's the net effect of those? 11, right? I have 11 understatement. How could that happen? It's the 11, right? My assets are too low by 11, which means my equity is too low by 11. Got it?
So it all goes in the total ending inventory.
It has to. Yep, it's always going to be the ending inventory. But it works, doesn't it? Flows through the inventory too, or through the equity account, through retained earnings. Okay? Those mistakes add up, they're cumulative. You don't close inventory, you don't close equity, you do close revenues and expenses, right? That's all that's happening. Okay, let's do 12. What does 12 look like? No air. In 2012, the ending inventory is no air. And you have 11 too little at the beginning, right? So where are we going to be? If 11 too little, hey, how you doing? Purchases are okay, right? Available, 11 too low, right, everybody? What's wrong with cost of goods sold? Obviously. Available is too low by 11. What's wrong with cost of goods sold? Too low by 11. We've got fond memories. Okay. Too little by 11, right? Everybody agree? What's that going to do? We plug it in the income statement. Revenue's okay. Expenses are going to be what? Too low by 11, correcting that prior year's mistake, right? Which is going to make net income what? Nobody's saying anything, but you guys know this, right? Too high by 11. Okay? What was the reported income?
56.
And what should it be? 45. Okay? So your answer should be 45 for that one. Okay? What's that going to do to the assets now there's no air? No air. Nothing's wrong. Is there anything wrong with the liabilities? Of course not. Would there be anything wrong with the equity? No. Everything's good. Okay, do this. Add together the incomes that were reported. What were they? 50 plus 52 plus 54 plus 56. What does all that add up to? 50, 52, 54, 56.
12.
Do 12. Because at the beginning we had no air in the inventory, and at the end we have no air in the inventory, right? Everybody agree? Add up our new net incomes. 47 plus 46 plus 74 plus 45. It's 212. A miracle. At the beginning there's nothing wrong, at the end there's nothing wrong. Of course they're all okay. But can you see how they might be smoothing here? They're reporting 50, 52, 54, 56. Doesn't that look nice? What's their beta going to be? Real low. What's really going to happen here? They have 47, 46, 74, 45. Now what's their beta? Getting the idea? Higher. Yeah. Yeah. Okay. Do we need to keep going? You got the idea. Just the same thing. We good? Do the other two. These guys want to talk about something probably. Okay. You're just wandering aimlessly. You looking for me? Yeah. Give me a minute. Yeah. Do those other two. track them on through. Oh, did we do the? Yeah, we did the 11 down below, didn't we? Yeah, we did the nothing. Okay, do the other thing. What do you guys think? Oh. do something else while it's gone? Did somebody come here and work another problem? And we recorded you guys sitting there, so were you talking about me, I hope, at least? Loudly, so pick it up? That'd be kind of fun. Anyway. So you took a nap while I was gone. Let's try exercise then. Oh, this is a fun one. 8. Yeah, let's start with 8:10. Let's do 8:10. That's a fun one. That's good. So, exercise 8:10. Some more errors. These kind of hang people up. Oh, I didn't get your test ready yet. I got everything with the whack done. I'm sorry. I got everything with the whack done, and then I had too many interruptions and didn't make it. So, yeah.
Did it seem like people were doing better?
They're really good. They're really good.
Really?
But you guys take 8 hours to do it? I'm kidding. Yeah, no, but they're really very good. They're very good. Yeah, on balance. Really nice across the class. Yeah, so. Especially compared to those dismal quiz 6 scores. Right? Yeah. But I haven't done the WAP, so that's, what, 24 points? I think it was. I haven't done that yet. The other ones are really good. Okay, let's try 8:10. Martin Company makes the following errors during the current year. Evaluate each case independently, assuming the inventory in the following year is correctly stated. Okay, and then it says, instructions indicate the effect of each of these on working capital, current ratio, and retained earnings and net income. What the heck? What's going on with this thing? Okay, what's working capital? Working capital. Working capital. Funds I have available to work with to run my operations. Not a cash ratio, though, a working capital. Current assets minus current liabilities. You know what current ratio is, right? Current assets divided by current liabilities. Working capital is current assets minus current liabilities. Okay? Oh. You guys got some work to do, don't you? All right. And then it says current ratio. What's current ratio? Current assets divided by current liabilities. Am I right? Everybody agree with that? And then it says the current ratio is greater than 1 right now. Okay, so otherwise the math gets kind of weird. Okay, and then retained earnings. You know what retained earnings is, right? Okay, so what would be the impact on retained earnings, maybe? What happens to retained earnings? Okay, and then net income. So, net income is what's going to affect retained earnings probably anyway, right? Net income is going to come in here. Okay, so what happens with each of these? Ending inventory is overstated, but purchases and related accounts payable are correctly recorded. So what does that tell you? Inventory is overstated. Whole variety of ways you can do this. Just do it in your head if you want. Well, that's a little dangerous, probably. Inventory is overstated. This is too high, right? Which means my current assets are too high by the amount of the inventory overstatement. Am I right? Which means my current assets are too high by the amount of the inventory overstatement, correct? Okay. But purchases are okay. Okay, so that means when I do my cost of goods sold, my beginning inventory, cost of goods sold, my beginning inventory plus my purchases is my available. Plus my ending inventory is my cost of goods sold, which is one of those expenses. All right, everybody? Okay. So purchases are okay. Oh, I don't need to debit or credit purchases, and I do not need to credit or debit accounts payable. So my current liabilities are okay. Right? My current liabilities are okay. You guys agreeing with me here? I'm just finding out what's going on. Okay. And then want each one of these separately, so we're done. Right? So my beginning inventory is okay if they didn't say anything. What's wrong with my ending inventory? Overstated. So this is too high. So what's wrong with my cost of goods sold? Too low. It's understated, which means my expenses are too low. My revenues, they didn't say anything. They're okay. Net income is too high, which of course is what caused the equity to be too high. Am I right? I'm in good shape. All right, well, what's wrong with net income? It's overstated, which makes my retained earnings in total overstated. Am I right? Okay. What about my working capital? It's too high because, you know, it's overstated too. Overstated in at current asset named inventory. Overstated working capital if the current liabilities are okay, right? Everybody good? And then what's going to be the case in my current ratio? It was over 1, and now it is going to be what? Overstated. It's going to be higher, right? Because this is correct, right? So it's overstated too, and I'm done. Now, when you look at a problem like this, it's like, oh my gosh. And then when you start doing it, it's kind of a joke, isn't it? Okay? Just relax and do them. Okay? Let's try the next part of it. Both inventory and purchase and related accounts payable are understated as soon as purchase is recorded and paid for in the following year. So when they did record it, they probably did it purchase and credit cash. Huh? Okay, so they haven't recorded it all. So here we go. Let's do exactly the same thing. Okay. I wanted to have. Yeah, I'll do it in place. Working capital, current ratio, retained earnings, right? Okay. You don't have to write this down every time. You gotta know what they are, of course. I want to know net income, what's wrong? And I want to know retained earnings, what's wrong? Is that it? Okay. But really we'll do all of them, huh? Okay. My personal preference is just to have the whole thing laying in front of me. Cost of goods sold is going to be the expense we're dealing with. And cost of goods sold is going to be, if we're doing inventory, it's got to be cost of goods sold. Getting inventory purchases available.
Setting it up like that really does help you see.
Yeah, you can't screw it up. If you do, you can do it in your head, and a lot of people do. It's okay if you do, I don't care. But you can easily switch it, can't you? You know, the increase or the decrease go the wrong direction. You know, if you do it this way, it's really hard. And if you do the whole accounting equation like this, the whole balance sheet and income statement, it's got to balance, you guys. If you make a mistake, you'll see it, right? Most likely, you'll see it. Okay, so the second one, both inventory and purchases and related ending inventory, purchases and related accounts payable are understated. What happened was they understated the ending inventory because they failed to record the purchase. So they didn't have it in inventory, right? Does that make sense? And what happened was they're understating their ending inventory because they understated their liabilities. They didn't record the purchase, and then they didn't count it because, you know, too, both. I mean, they could have not recorded the purchase and counted it, right? Or they could record the purchase and not count it. All these type of things can happen, right? They're normal errors in businesses. So I think assets are understated, right? Ending inventory is the asset that's understated. Purchases are understated, and liabilities are understated, right? What do you think's wrong with equity, everybody? Well, come on, assets equal liabilities plus equity. What's wrong with equity? Nothing. What's wrong with net income then? Nothing. What's wrong with revenues? Nothing. What's wrong with expenses? Nothing. Why?
The purchases and ending inventory cancel each other out.
Yeah, this is okay. This is too low by the exact, that's exactly too low. You're right. That's exactly too low by the amount that's too low. So you fail to add something in and you fail to subtract it out, what happens? Nothing. Cost of goods sold is fine.
If the ending inventory is too low, then wouldn't the cost of goods
No,
sold be
because
over?
purchases is too low. I got two things going on. My ending inventory is too low, and my purchases is too low, and my accounts payable is too low. Right? Did I do it? We're there? So you just got to let yourself relax. So what's wrong with net income? It's okay. What's wrong with retained earnings? It's okay. All right, what's wrong with current assets? Too low. Current liabilities? too low by the same amount. What's wrong with working capital?
No effect.
This is 100, and this was 60. And it should be 110 and 70. What do you think? It's okay, right? If you were to increase your current assets by the same amount you increase your current liabilities, what happened to working capital? Nothing. Okay, that's fun. Okay, this just plays head games with you, doesn't it? Okay, so I'm just making up the 160, of course. Okay, so then what?
And this is only assuming that they're the exact same numbers, right?
No. It doesn't matter what their numbers are, you changed them by the same amount.
Yeah, so that's what I mean.
The difference, the working capital is the same
As long
number.
as they're changed by the same amount.
Yeah, if they're changed by the same amount, the working capital stays the same.
Yeah.
You got it. Is that going to be true of the current assets? No. Let's say this was 100 and this was 60, right? Let's say that's what it was. Okay? What's my current ratio? That's a CR, not a CA, of course. What's the current ratio? 1.66. Is that what that is? Yeah, 1.67. Okay, what will it be? Let's say it was 10. So this should be 110. Current assets should be 110. And current liabilities should be 7. Would it be the same? No way, right? So what's 110 divided by 7? 1.57. So what would you say? It is what? Overstated right now, right? Should be less. So this is what it is now, this is what it should be. Just a hypothetical. It's some distance less, right? No matter what the error was, some distance less. I'd say it's overstated. Can you guys pull this thing off? Overstated, that one's overstated, okay, okay, okay. And is that it? Yeah? That'll make you nervous, huh? Indicator's okay, net income's okay, working capital's okay, current ratio's screwed up. Okay? Gets you thinking a little bit. Okay, so we do working capital again. I like these kind of things. I think it really solidifies your understanding of how all these relationships work. So I know you love it when I like things, don't you? Okay, and what else do we want to know? Retained earnings and net income. Was there anything else? Where do you have current ratio? Retained earnings, net income. Okay, 3. Ending inventory is correct, but a purchase account was not recorded. Okay, so this time, what we need to do to fix this is debit purchases and credit accounts payable, right? You guys agree with me on that? But when they counted the inventory, they included, can you see how this had happened? You failed to record a purchase, and then you mess up, right? But you do count the inventory. That's probably more likely than failing to record the purchase and not counting the inventory in the last one, right? And it's more likely you get one of them right, okay? Could you record the purchase and not count the inventory? Yeah, of course, right? Then the inventory counts off, okay? So let's try this one, exact same deal. And you guys know how haphazard I am and how lazy I am, but at the same time, I like to get things done fast. I discipline myself to write stuff down like this, don't I? It really makes it faster. That's why I do it. I don't think it's a waste of time. I think it's going to make your life go faster than to not write it down. Do you think it's true in the WAC cap M? If you actually write down what you're doing as you're doing it, it works. And if you don't, you lose something somewhere. You need a certain amount of discipline, right? A certain amount of things done. And accounting's kind of that way. We write down lots of stuff, right? So we can find it later, not looking for computers. It's nice. Okay, and then of course it's going to be cost of goods sold, beginning inventory, plus my purchases. And this really reinforces that you know this, of course, which I know you do. Available, less the ending inventory. I should not have put that line there. Less the ending inventory. It's going to be my cost of goods sold. Okay, so what we need to do here, the ending inventory is okay, right? This is okay, which probably means the assets are okay. Everybody agree with that? Yes.
How is it possible that you don't record a purchase but the ending inventory is correct?
Because counting the inventory is separate from recording your purchases. Right? You go physically count the inventory and you adjust the inventory from where it is to where it should be, right? So if you fail to debit purchases and credit accounts payable, you didn't realize it, you'd still adjust your inventory. And you might just think, some inventory magically appeared, kind of. Your inventory, missing inventory changes, that kind of thing, right? So it's, there's a lot of moving parts. Okay, good. Good question. All right, we think probably the beginning inventory is okay. Purchases is missing, right? It is what? Understated. Available is understated. Cost of goods sold? Understated, right? Expenses understated. Revenues? Cost of goods sold is the expense understated. If you fail to record the purchase,
Well, if our purchases are understated, then wouldn't our assets be understated? Or
No.
have we already?
no, because we counted it, we got the right amount. To answer your question, what account screwed up? You would
Yeah.
debit purchases to fix this and credit what?
The accounts payable?
Yeah. So what's wrong with accounts payable? Here's the entry you'd need to fix that one. You can write it down. Purchases and accounts payable, right? So purchases are too low, because we didn't do it, and accounts payable is too low too, huh? So, liabilities are too low. This is gonna fix it for you. So what's wrong with revenues? Nothing, right? Didn't say anything about revenues. So if expenses are too low, what's wrong with net income? It's too high, and what does that overstatement do to equity? Too high. Does an understatement of liabilities and overstatement of equities add up to zero? Yes. Got it. Everybody good? So we got those. A lot of times I'll just ask what happened to all these accounts over here. And I did that in principles, remember that if you had me for principles? Drove me crazy with these things. Okay. So what happens with working capital? Current assets are okay. Current liabilities? Too low, which makes working capital understated, too low, right? Correct number minus too low a number. Whoops,
Didn't we say it's too
I
high?
said it backwards. I thought it backwards. Wow. The correct number minus too much is going to be what? Minus too little. Minus too little is going to be what? Overstated, yeah. Right? So if I had, let's make it 10 again. If I had 100 here and 60 here, but it should be 70, what would I have? I'd have 40 instead of 30, wouldn't I? Should be 30 and it would be 40. You guys with me? So sorry about that. Thank you for talking. You guys are getting so much better at stopping me when I screw up. And that's a really positive sign. Debits have to equal credits, right? Okay, current ratio, what do we have? Current assets are okay. The current liabilities would be what? Too low. So what happens to your current ratio? Let's say you had 160 like we did before, and what would that be?
6
Yeah, but now it should be, that's a 60. Now it should be 170, we realize, right? What would that one be?
Lower than 4.
1.3 or something, is that what that is?
It's lower than 1.67.
Okay. So what would you say? The current ratio is too high, overstated, right? Okay? All right, no matter what the numbers are, you don't care what the numbers are. Retained earnings? It's overstated, right? Because net income is overstated. Okay? There are other good, the 311 does the same thing. Current assets, current liabilities, what happens to what happens to current ratio? Yeah, so it might crank you out. See here. Here's a fun one. Inventoriable costs. What's an inventoriable cost, anyway? I'm looking over on, exercise 8.5 on page 453. Try that. What do you mean by inventoriable cost? What cost is included in inventory? What's a product cost versus a period cost, everybody? Remember from accounting 1 and 2, you had product cost. Cost of what?
Like marketing for that would be product cost.
Marketing would be a product cost? Marketing the product? What your material? How about product cost or the cost of what?
Product.
The product. Which means what? If I buy it from somebody else, it's the cost of it. But what if I manufacture myself? It's the cost of it. What's the cost when I manufacture myself? Direct materials, raw materials, and labor, direct labor, and applied overhead, right? The overhead expense, right, guys? Those are the product costs. The period costs are the costs that I incur in the period to do everything else, my operations. That's where marketing would go. Making sense? You know, it's still affiliated with the product, but it's an operating cost. Okay? So marketing, general administrative expenses, research and development expenses, you know, accounting, accounting operation, right? Finance operation, right, guys? Okay? All that stuff. Human resources. All the things that we incur, whether we sell anything or not, or whether we produce anything or not. Okay? We separate product from period. So that's one thing. But what costs are inventoriable in a detailed sense, would you think? All the costs of producing the product, materials, labor, and overhead, and maybe if you're building a building, the interest cost during the period of construction, you can capitalize that interest, right? Ordinarily, you don't capitalize interest in inventory, but if it's a building or a bridge or something and you have interest, yeah, you put that in there, up to the point when you're done, and then what do? Expense it thereafter, right? When it's ready to sell, you start expensing it. Okay, anyway. So we're gonna lose our outside light, I guess. Or I'm gonna be blind. I could put on sunglasses. Anyway. So let's take a look at this. When you have something delivered to you, have you guys ever bought anything? Oh, I know you have. It used to be catalog. Now, and then it was in mail order, right? Now it's online. When you buy something online, have you ever seen that sometimes the freight's included and sometimes it's not? What do you always think about when you think about how much you're paying for something? How much it costs before freight or how much it costs after including freight? I think after including the freight. What do you bet the freight is part of the inventoriable cost? It's a cost you incurred. How about taxes and duties to get it delivered to you? I think it's part of the cost. How about anything you have to pay to get it? When we get into property, plant, and equipment, how about getting the title cleared on the land that you're buying? Paying for the title search. That's part of the cost of the land. How about if there are back taxes that haven't been paid and you pay them so that you can get title to the property, right? Because you're buying it from some deadbeat that didn't pay their taxes or whatever. Okay, so you're buying this stuff and they haven't paid their taxes. What do? You pay them. That's part of your purchase price. It's just more purchase price. You could have paid them more than they paid the taxes, right? You could have paid more for the product and they pay the freight. So you got the idea? So what's inventoriable and what's not is always a big decision, okay? Well, great decision. So let's try these error adjustment ones. So this is the inventorial cost when they made mistakes. Okay, Craig asked you to review his December 31st inventory values and prepare the necessary adjustments to the books. The following information available, and so they did a whole bunch of stuff. Determine the proper inventory balance at the end, and then prepare the correcting entries to adjust the inventory to the proper amount. Okay, I have a really clever idea. This is inventory. Let's write down all our debits and credits and we'll make journal entries on to reflect those debits and credits. Okay? Craig uses the periodic method. By the way, would you guys like me to email you your test scores or would you like to come by? I can email you when I got them ready and you can come by and get it if you want. How about that? Okay, I'll just email you a blanket email that it's ready, and then if you want me to email you your grade, you can, instead of picking it up, you can email me back and I'll respond. How does that sound?
Are you gonna have them ready tomorrow or Friday?
I don't know. That's my problem. I'm going to try to have it ready sometime tomorrow. Okay, I hope so. I only got like maybe an hour to mess with them. Because by the time you do all of yours, because guess what? Everybody's answer is different on the last problem. That's the only one I have left to do. Everything else added up, ready to go, I just have to add it to it. And I got up at 7 this morning, even though I feel awful, don't pick on me, okay, anyway.
I mean, I feel bad too, but
Yeah, you're here, yeah, no, do your job, please, I like that, that's good, I like that. When you go to work, do exactly the same thing. I mean, but I got tied up with a bunch of students and stuff, yeah, so anyway, okay.
Did you handle the interest expense on the WAC problem?
Oh, the interest on the WAC, there was almost no interest. How much interest did you guys find?
I got 0.
0.6%,
Yeah.
0.6% interest, some people found. If you go into the note on capitalized leases, it says what the interest rate was. That's the only way you can find it, I guess. Because they didn't separate the dollar amount of the interest, did they? Yeah, so that was a good spot. What did you guys estimate the interest to be?
3.85.
0. Where'd you get 3.5?
It said
I
that.
found it on
It
it.
said it.
In one of the notes, it said that,
Adjusted
yeah,
rate.
4.5 or 3.5 or something, yeah, so
Either or.
either or, you
Yeah, it's
took the
either
high.
or. 0.6 or.
It's the original line rate.
Yeah, and they didn't tell you which one they really had, did they? Yeah, we just read that before we started in here. I guess I'll have to be lenient and let them both go, yeah, anyway.
So what
Thanks for
would,
the feedback, though.
so what would be like the proper way of like doing that? Would we have just stated interest
In
rate
real
is
life,
just one?
I don't think it's gonna be material. Like, if you calculate it either way, I bet it doesn't make much difference in the price. In the weights,
and there's.
some people got different weights, though. How would you get 7% or 5% for the debt? Why would it be different? I don't know, I'll have to look at what debt you picked up. I was just glancing at it, you know.
Yeah, maybe people use the market cap
Yeah,
that was
market
listed.
cap and their estimate.
Oh, that's right. If you used a different market cap.
Cause the,
Yeah, the outstanding shares times the market price didn't equal the market
no,
cap.
it wasn't even close.
Wow.
That makes sense because that would have made it
That
like
would
more
do
than
it.
95.
That would change the percentage.
The market
Oh,
cap was
man.
bigger than
I just
what the
market
actual.
cap. I like wrote you a note on that.
Oh, good for you. I like that. When you do the CPA exam, remember that. You can't figure something out and tell them what you assumed. I assumed this, and they might look at it and say, well, you assumed wrong, but, you know, but at least they know what you did, right? They can follow your work. So that's good. I like that.
Yeah, that one was true.
Yeah, I didn't really mean for it to be, but it's kind of fun. Neat one. I meant to give you one that had very low risk, very low, it's not really low risk maybe, but low variability returns. And then that had almost no debt too, which is why they have low risk partly. So the WAC and the CAPM are almost the same, aren't they, no matter what? We're really close, yeah. So, anyway, yeah. So, then the other one was, so, did some of you use MS Finance, any of you guys? You guys said that MS Finance, somebody found a
The
beta
beta's
one?
different. Yeah, the beta is like, for like Google Finance, it had like a beta of like 0.7 or something like that, and the other one.
Google
was like
Finance is
0.1.
always different than the other ones.
Well, there's another
I don't know
one
why.
too. Well, that's stuff with Yahoo, because that's what you said.
Yeah,
to use.
yeah. Okay, did I say to use it in a problem too?
I
Oh,
just
good,
saw
did I
under
mark everything wrong?
instructions.
Yeah, yeah. So people are just looking around. I'll spend some time on that probably, huh? Simple financial statement, yeah, yeah. It's easier than said, and it's an art, right, guys? Not a science, it's an art. You just get it. But you get really good questions, don't you? Do you know more about that company now by having done that? That's a simple thing. You know, wow, what if you really read the whole financial statement and thought about it? You'll be doing this stuff, right? You know, what's going on? What's really happening? You don't just read. Okay, good. Enough on that stuff. So, somebody have an email handy? Phone email. Email me and tell me, say, Keith, you are going to send us notice that the grades are ready. I don't forget. Okay. I doubt if I'd forget that because I'm gonna grade them, but you never know. All right, and then you can come by if you're around today. Because we won't see each other till Monday, I guess. And on Monday, we're doing a what? Quiz, yeah, let's not forget that. Okay, good. All right, we were gonna do number 8.5, is that what it said? Error adjustments. Craig uses a periodic method for recording inventory. The count reveals 234,890 of inventory on hand. I don't think that's an error. I think that's just what it is, right? So they're gonna adjust their inventory. Periodic means they physically counted it. They're gonna adjust their inventory at the end of the year to 234. 890. And what we want to do is figure out what the number really should be. That's it, okay? Not including the physical count is 13,420 of inventory purchased on December 15th from browser. It was shipped FOB shipping point. Okay, what does FOB shipping point mean? Free on board, which means what?
We included as inventory.
Yeah, because title transferred on that date to us, right? Free on board is an old term, but it means who's paying the freight, right? But you pay the freight if you own it, right? So free on board, shipping point means that we own it when they ship it. When it's on the truck, we own it, or on the, on the boat out in the ocean for 2 months, right? It's ours, right? FOB shipping point means we own it.
So until it changes hands.
No, it changed hands when they shipped it.
Okay.
When you buy something FOB shipping point, it's yours when they ship it to you. When you sell something FOB shipping point, it's theirs as soon as you ship it.
It's just like who's liable for it.
Who's liable for it, who owns it.
Right.
They own it, so they're liable for the freight, they're liable for the insurance, they have to pay taxes on it, duties, you got the idea? So it's the title transfers. I like this one. Have you guys ever bought a computer online? Right, from Dell does that, and yeah, parts and stuff. They always sell it to you FOB shipping point. Why? It's a computer, and if it doesn't work when it gets to you, it is your problem. Right? You deal with the freight company.
So when they ask you to sign it, that's not information. Like when they come to that, like signature.
No, they're doing that just to prove that they delivered it to you so they can collect the freight. Yeah, from you or from the other folks, yeah. By the way, it could be FOB shipping point and the shipper still pay the freight, but that's as a courtesy for the customer, right? And then they'll bill the customer for the freight because the customer's responsible for it. So it's determining who has to pay the freight too. But what we care about here is it determines who owns the inventory, right? And they go together, of course. So do we own this inventory is the question. We bought it FOB shipping point on December 29th. It arrived in January. The invoice arrived and was recorded on December 31st. So what we did was we debited, oh, wait a minute. What kind of inventory system do these guys use? Periodic. What did we debit when we got the inventory? Not inventory, that's perpetual. I'm not perpetual keeping track of how much I have. This is periodic, I'm debiting purchases. So my purchases account is okay. My inventory account is not, right? I didn't add it to inventory. Okay, that makes sense? Okay, so we've got to be careful. If it was periodic, if it was perpetual, I would have debited inventory, it would have been in there. But then when I counted, if I adjusted the new count anyway, I might still have it screwed up, right? I might still not have it included. So anyway, I need to include 13,420 more, don't I? Right? But I don't have any problem with accounts payable there, it's recorded, right? Purchase is okay, accounts payable is okay, my inventory is just too low. So I'm gonna put 13 in here. Okay, let's do the journal entry. What's it gonna be? Well, this is interesting. If you think about your here we go. Oh man, stuff just drives you crazy. It's always this. Okay. This is okay. They just told us. This one's okay. It was recorded, right? Okay. That one's okay. Everybody agree? We've got it recorded. This is okay. Ending inventory was too low by that amount, right? Okay, which made cost of goods sold too high, right? Cost of goods sold is too high. Revenues is okay, right? Net income is too low, right? That's that cost of goods sold there, all right? Makes equity too low. Assets must be what? Obviously, that's the ending inventory is too low, right? They didn't count it. They didn't include it. What's your journal entry? This is going to be debit inventory for 13,420. And credit what? My cost of goods sold is too high. Cost of goods sold. Or income summary if you don't use a cost of goods sold account, right? with a periodic system, you might be using income summary instead of closing it into cost of goods sold. But assuming they put it into cost of goods sold, its cost of goods sold goes down. And you get the credit for that if you did it. Okay? I don't know what the authors did in there, probably. You can look it up. That make sense?
Yeah.
Yeah, cost of goods sold is gonna go down either way. If you credit the income summary, that's the inventory change, right? Okay. All right, wow. Next one, included, in inventory is merchandise sold at Champy FOB destination. This merchandise was shipped after it was counted. Oh, this is FOB destination. Okay? Free on board destination. So what does that mean? We own it until it gets, we're shipping it, right? Is it shipped to us, away from us?
Sold it to them.
We're selling it, yeah, we sold it to Champy. So we're shipping it out. It's FOB destination. Is it theirs or ours? It's ours until they receive it. Oh. And then it says the merchandise was shipped after it was counted. Good. We included it in our inventory. So we should include it. So is anything wrong with our inventory? Nope, not for that one. What else do we have? The invoice was prepared and recorded as a sale and account at 12/8. It cost $7,350 and they received it January 3rd. So that $7,350 is included in our inventory and is not included in our cost of goods sold. What do you think? Good. We didn't sell it. True? I'm glad that it's included in our inventory because it's still ours. Am I reading it right? Still ours, isn't it? Everybody agree? And I should not have any cost of goods sold. So I don't have a journal entry for inventory and cost of goods sold. But be careful. They prepared an invoice and recorded a sale on account at 12/8. What they did was they credited sales for 12/8 and they debited what? Accounts receivable for 12/8. So what do you think? I think accounts receivable is too high by 12/8. I think liabilities are okay, so what's wrong with equity? It's too high by 12/8. Why is that true? Revenues are too high by 12/8, which makes net income too high by 12/8, which is what causes equity to be too high by 12/8. I think you need a journal entry for 12/8 even though you're not changing inventory. What would that be?
Reverse it.
Reverse it out. So credit accounts receivable,
Sales.
debit,
Sales.
sales revenue, whatever they use. Not too bad, huh? Just relax. Let's try 4. This is a neat problem. Included in inventory was merchandise received from Dudley with an invoice price of $15,630. It was shipped FOB destination. The invoice, which has not yet arrived, has not been recorded, but we know it's going to be for $15,630. It was received on December 31st, and we included it in our inventory at December 31st, and it was shipped FOB destination. I don't care how it was shipped. It's ours either way, isn't it? It's included in inventory, isn't it? Well, we haven't recorded the purchase. What do we need to do? Record the purchase, right? Okay, so what's that going to do, everybody? What's that one going to do? What do I need? You guys help me. I'm doing too many of these for you. Probably won't happen on the test, right?
Well, should we set a variable?
Yeah. So you think they should credit accounts payable? Should they have more accounts payable? Yeah. I think a credit accounts payable. For how much? $15,630, is that what it was? Am I on the right one? Debit purchases, excellent. Because they are periodic. If they were perpetually debit inventory, right? All right, 15,630, wasn't it? So what does that do? That'll increase my purchases. So here I am, I'm increasing my liabilities, I'm increasing my purchases. The increase to purchases does what? Beginning inventory is okay, available would be what? Wait a minute, I put my arrow backwards the way I've been doing things, I apologize. My purchases are too high or too low? Too low, right? I failed to put it in there. This is too low, right? I did my liabilities backwards too, I might as well be consistent. My liabilities are too low, right? I failed to record it. My liabilities are too low, my purchases are too low. That makes my available too low. My ending inventory is okay, I guess. So my cost of goods sold is too low, right guys? Available is too low, which is gonna make my cost of goods sold too low, right?
Yeah.
Revenues are okay, which is gonna make my net income too high. So if my net income's too high, what does that do to equity? Too high. Oh, good. So my assets are fine, right? There's nothing wrong with the inventory. So then too low on the liabilities, too high on the equity. And the way you fix it is to debit purchases, right? Which is gonna lower my equity because it lowered my income, right? Increased my cost of goods sold, lowered my income, lowered my equity, and then the credit accounts payable increased my liabilities. Yeah.
And we debit purchases instead of inventory because it's periodic.
Yes, it's periodic. And periodic, when you buy inventory, you debit inventory, right? That's periodic when you buy inventory, you debit purchases. If you're perpetually keeping track of how much inventory you have, you debit inventory with you. Okay? But then you'd also have a cost of goods sold account. You'd have to work with that, right? Okay? So it changes if they made it a perpetual problem. Okay? You see how this stuff kind of gets to people. 5, not included in inventory is 8,540 of merchandise purchased from Glauser. This merchant was received December 31st after the inventory had been counted. The invoice was received and recorded on December 30th. They did not include in inventory 8,540. It was received December 31st after the inventory had been counted. So what do you think? Inventory was received and recorded on December 30th. Should they have included it? Yes. Yeah, and they failed to include it, right? And they did record the invoice. So what they did was they just screwed up their count, didn't they? So what would we do with this one? It's not in the inventory, should we add it? Yeah. I think it, you guys all agree with me? Am I reading it right? Okay, 854 all. So I should have more ending inventory, right? So my ending inventory, and I know I'm going to debit inventory, don't you? For 8540. Obviously, if I put it in the T account, I better debit it, huh? And I need to credit something. But they've recorded the payable, they've recorded the purchase. So my beginning's okay, my purchases are okay, my available's okay, but my ending inventory is too low. Am I right? Which makes my cost of goods sold too high. Which means my expenses, of course, cost of goods sold are too high, right? Revenue's fine, cost of goods sold are too high, expense too high. Net income is what? Too low, which is going to make what? My equity too low this time? Is that right? And that's because my what? Asset inventory is too low. Good. So what I'm going to go to is what? Debit inventory and credit what? What do I want to have less of? Cost of goods sold. Same as this one here. Now that's assuming I'm using a cost of goods sold account. If I'm leaving it in income summary, it'd go to income summary, right? My inventory change was wrong. It's wrong. Okay? If you want, you can close what's in the income summary for inventory change and the cost of goods sold, right? You close your purchases and the balance in income summary to cost of goods sold, right? What's so excited, you guys? It's thrilling to be here doing this. Okay. Right? It's going to be thrilling when you get your paychecks. Right? That's thrilling. She's already thrilled. A little bit thrilled. Well, you know how much the people you work for make, right? Storage. They don't really tell you, do they?
I do payroll, so.
Oh, so you do know. Yeah, it's scary. What's really fun is when you don't do the executive's payroll probably yet.
No, I enter it, but I don't.
Oh, you know how much the gross is then? Yeah, it's big, isn't it? It's ugly, yeah. They're not worth it, you can tell when I said that, yeah. Nobody's worth that much, yeah. Don't worry about it, none of us are worth what we get. Well, you guys are, we get now, but later you won't. Yeah, you won't. It's not fair. Some people get far more than they should, and other people don't get very much. Call it capitalism like that. Anyway, that's okay, because all our problems are solved now because we have a Tea Party governor, so economy is just gonna take off. You guys all voted for him, right? Because you really want to pay more tuition. Now you're not gonna pay more tuition, that's all the state school kids are gonna get, well, wiped out. It's probably good for Bellarmine, right? Why is it good for Bellarmine? Their tuition goes up, our state's the same, we're relatively a better deal. Or we can raise our tuition and be better off too. So either way, we're better off. Yeah.
Is he looking to like raise state tuition?
Politicians say they're gonna do all kinds of things. He said he was gonna take 500,000 people that just got on the insurance. You know, with our current governor, he's gonna take all their insurance away from them. He already said he wasn't even before they ran the election. So, you know, he says all kinds of stuff. They're gonna eliminate taxes and the economy is gonna boom. Right? That'll happen. You know, if we don't have roads and we don't have bridges, I bet the economy would be real good, right? We don't have education, you know, let's get rid of K through 12. He didn't say that he was gonna get rid of, early
Head
childhood
Start,
education.
yeah.
Yeah,
And drug test, senior,
yeah.
for Social Security.
Your candidate won though, right?
Yes.
Barely. And she's outstanding.
Counts.
I'm sure glad I voted. All those, you know, they were heading to all the polls too. Right?
Pay attention to polls.
Yeah. It's who votes. People who vote determine the outcome of elections, not people who answer a poll question. People who go vote. And so anybody who is upset about who gets elected ever and has not voted should keep their mouth shut. I voted and I lost again, right? I lose a lot because I'm obviously wrong. Correct? It must be wrong if everybody doesn't agree with you. Anyway, that's funny. Funny things happen in campaigns. Did you guys know that we've had, in the last, was it 30 years? This is our second Republican
It
governor.
was almost 45, it was like
45 year range? Yeah. I don't know. So, it seems like poor people voting against their own self-interest. Yeah, lower taxes on the wealthy. I'm not wealthy, I'm just sort of upper income, upper middle. We're better off. They lower taxes. They are. So we just try to increase our contributions to charities and keep doing it. I don't know what else we do. So, unfortunately, everybody doesn't do that. It should though. So what else was this? I don't know. Let's get off that. That's all. Included in inventory was 10,438 of inventory held by Craig on consignment. Oh, wait a minute. What's consigned inventory? I have their inventory that I'm holding to sell for them. Is that my inventory? No. All right. So I included that in inventory. Should I? No. What if I had consigned inventory out of some location and I failed to include that? Oh no, that's my inventory, I should put it in, right? You go into a Hallmark store, that store is full of stuff that does not belong to that store. You know, all the lighthouses my wife buys, we used to buy a lot of them, right? You know, the house is full of lighthouses, she don't buy them much anymore. But anyway, you know, they're these nice little replicas of lighthouses, right? Those lighthouses. Whoever produces those things owns them and they put them in the store. They own the inventory until Hallmark sells it, and when they sell it, they immediately buy it, right? Make the purchase and sale at exactly the same time. That's done a lot, consigned inventory. Okay, so this is not our inventory. We're going to take it out of there. So guess what my journal entry is going to be? Excuse me, what's my entry going to be? Credit inventory. Okay, now do I have anything else wrong? Do I need an account payable adjusted? What's it going to hit, obviously, now that we've done a few of these? It's going to go to cost of goods sold, absolutely. And how is that going to work? what we did was we have too much, our beginning inventory is okay, our purchase is okay, our available is okay, we have too much ending inventory, which means cost of goods sold is too low, is that right? So what do we need to do to cost of goods sold? Make it more, debit it, which is gonna make our expenses more, our revenues are okay, it's gonna make our net income less, which is gonna make our equity less again, right guys? And the reason it's less is because inventory needs to go down, both. Got easy, didn't it, after you do a few of them? Okay, and then we're up to 7. Included in inventory is merchandise sold to Kemp, FOB shipping point. When did it get transferred to them? Ownership. When we shipped it, it's FOB shipping. It was shipped after it was counted. Should we have included that in inventory? No. So, right? It's theirs, not ours. Okay? It was recorded as a sale for $18,900 on December 31st. So we debited accounts receivable properly and recorded sales. Is that okay on December 31st? Yeah, we shipped it. We don't have to change sales or accounts receivable. They're fine, aren't they? You guys agree with that? The cost of merchandise was $10,520. So what do we need to do? Debit inventory? Included in inventory is merchandise sold to them, though. We included it and we shipped it. So we need to take that out of inventory, don't we? Am I right? Am I reading it right?
Yeah.
I think 10,520 comes out of inventory. Okay? So I'm going to credit the inventory for the 10,520. What do you want to debit for 10,520? This one's going to be cost of goods sold again, isn't it? Right? How about if they had failed to record, this is the same story, right? Same story. How about if they had failed to record the sale? Now what would you need to do? Debit accounts receivable and credit sales. Make another entry, right? Because they could have said that, but they did record it, didn't they?
So you would do both of those entries, or only?
Oh, I'd still do the cost of goods sold.
Just
Yeah.
addition.
Yeah. But they got the sale recorded, but not the cost of goods sold. If they hadn't recorded the sale or the cost of goods sold, they'd have to do both.
So that just.
If they recorded the sale and not the cost, or they recorded the cost of goods sold and not the sale, I'd only do the sale. In fact, that was this one here, they recorded the sale, they shouldn't have, I guess, we forgot. You getting the idea, though? Just fix what's wrong. Yeah. So. Okay. Excluded from inventory was a carton labeled, please accept for credit. Now, somebody returned something. It contained merchandise costing $1,500, which had been sold to a customer $2,600. No entry has been made on the books to reflect the return, but none of the merchandise seems damaged. What do we do with that one? What should we put back in inventory? It returned to us. We sold it for $2,600. It cost us $1,500. What do you think your cost of goods sold was that you recorded? $1,500 for that. Am I right?
Yeah.
Okay. So we should put $1,500 back into inventory, don't you think? $1,500 goes back into inventory. I am going to debit my inventory for $1,500. What are you going to credit for that? It's the same story, isn't it? If it should have been in inventory and it's not, you've got too much what? Cost of goods sold. But we're not done yet, are we? Because they have a sale that they recorded for $2,600. Probably debit accounts receivable and credit sales for $2,600. Now they return it instead of paying us. So what are we going to do? It's not a sale. Debit sales or an account named sales returns and allowances, which is more likely. Keep track of it. For the $2,600 sales price, is that what it was? And credit what for $2,600? What don't we have anymore? The account receivable. Or if I'm going to refund them cash, right? I give them cash. You know, they'd already paid me. True? We did them all. Do this first. What is the balance in the inventory? Right? 234,890 plus 13,420 plus 8,540 plus 1,500 less 10,438 less 10,520. Isn't this a fun problem? 237,392. Anybody else get that?
Yeah.
Okay, great. Good deal. Piece of cake, huh? Welcome, you guys that are late. Funny, huh? Okay. I guess I'll leave this recording and we'll have another 3-hour one. Otherwise, better, huh? Because otherwise it'll take 20 minutes to save it. We wouldn't be able to record the rest of you tonight. We'll do some more tonight, obviously.
Question. So it's like a setting up you want to see it.
Oh, did you record it? That's recorded. There we go, all right. The red one's recorded. Okay, anyway. Maybe we'll try one of those though. See if we can get through one pretty quickly. Let's try, that's the same type of problem example that we did, 826. Take a look at exercise 826 on page 459, and we'll do at least the first couple of years of this thing. Okay, what do we do? All I'm doing, guys, is I am going out and counting my inventory at the year-end purchase price. What would I have to pay at year-end? So imagine how easy this is. You count your inventory, right? And you price it your year-end price, okay? But you keep track of over time how much the cost goes up. You compare your retail, or I'm sorry, you compare your purchase price, your wholesale purchase price you would pay when you're buying it. You compare your price this year to last year to the year before, right? So you start with a base year, and then you look at what the inflation has been year after year after year. That's all it is, okay? So in this problem, on 826, we have 70,000 inventory when we start. Everybody see that? That's my base year. So it cost me $1 to buy $1 worth, right? In the next year, at December 2011, there's 90,300, but it cost me $1.05 to buy what $1 would have the year before. 5% inflation. It doesn't have to be inflation in the whole economy. It's inflation on this inventory item, right? Or this type of inventory. Everybody got the idea? In the next year, there's 95,120 of inventory, but it would have cost me $1.16 to buy what $1 worth would have in the first year, the base year. Everybody see it? So each year we know what it is. So what we're going to do is we're going to convert each of these into the base year dollars, and then see if we have an increase or decrease in inventory. Every time you have an increase, you have a new inventory layer. If you have a decrease, you deplete layers. In LIFO, that's what happens, right? You keep track of the layers, okay? You read this chapter, that coming back to you from principles, right? There's a lot in this chapter too, but it's stuff you have principles, most of it, okay? All right, so we're just keeping track of all our layers. So let's do this. We start with 2010, 11, 12, 13, 14. Okay, year-end inventory. This is at year-end inventory purchase dollars. It's not historical cost of it or anything, okay? It's what you'd have to pay to buy it at the end of that particular year. So it's 70,000 here, 90,300. You can do it right on the page in the book if you want. 95, 120, 105.6, and 100. Okay? So in year-end dollars, that's what it would have cost. Okay, what's the index for each year? And what this is how much inflation there's been. That's all it is. We got 100, so that's the base year. So the $70,000 inventory is a $70,000 inventory, right? It's worth $70,000. 105. I'm going to divide 105 into the 90,300 to figure out what that would have cost in the base year. 116, same thing there. 120, 125. So what this is going to be is base inventory dollars, okay? Well, obviously 100 into 70 is 70, so you don't need to do that one. You can if you want, but it's going to be 70. And then we're going to take it times 70, times 100%, it'll be 70 again. What's 105 into 90,300? Here, guys, quick. 90,300 divided by 1.05. 105% is what we need. 86. So what happened that year? How much increment is there? In other words, increase or decrease in in inventory?
16.
16. So what I've got is a 70,000 layer from the base year, right? Plus a 16 increment the second year. Everybody agree? Got it? Okay. So how much then is the inventory going to be? This 70,000 I'll then take times what? 100, right? Because it's, I divided by 100, took it times 100, it means nothing. 70,000 is the layer from the base year, which is 2010. That's the 2010 layer I have at $2,010, okay? I just added 16,000, didn't I? And what is that? I bought it in the second year when the price index is 105, because that's new inventory, right? It's in base year dollars, what it would have cost in 2010. But I bought it in 2011, right? And that's an increase in inventory, an absolute increase in inventory. I have more inventory items, right? I'm not tracking items here, just dollars, aren't I? But I must have more items, okay? So 16,000 times what, everybody? 1.05. You got it. That's it. And that's going to give me the 2011 layer. How much is that? 16,800. Okay, so if I was doing, whoops, 16. Thank you. If I was doing my inventory, then obviously at the end of 2011, how much would I have for my inventory on my general ledger? 70,000 from the base year. It's LIFO, right? That's the old ones. And then my new ones cost me 16.8, right? The new layer. I'd add the two together, I'd have 76.8. Is that working? Those of you who weren't here for the review when you started this. Working? Okay. So 86,800. And you can watch me do it the other problem if you want. Okay. On the video. Okay. 86.8. Right? That's the balance sheet inventory, right? Financial statement, balance sheet inventory at when? 2011. It would include the 2010 layer and the 2011 layer. Got it? Okay, let's do another year. Divide 116 into 95, 120. Let's do 2012. What's that number?
82.
Ah, look what happened, you guys. I depleted some of the inventory, right? In base dollars, that's all it would cost me. If I was buying in 2010, it would have cost me 82,000 to buy that inventory, is what I'm saying. Okay? So it goes down by 4,000, doesn't it? Well, what went away? What don't I have anymore? It's LIFO, you guys. Which layer's gone? Not the oldest ones, the newest one. The first one up here, yeah, the next one, right? Okay, so which one's partly gone? This 16 is now not 16. What is it now? There's only 12 left. You guys good? The 16 is gone, and it becomes a 12, doesn't it? Everybody see what's going on? All that's left of that 16 is 12,000. So this layer is gone, isn't it? Okay? It's reduced to 12. But what did those cost? $1.05. It cost $1.05 to buy what $1 would have in the base year. So bring them back up at 105. And how much is that? It's no longer 16.8 for the 2011 layer. What is it? 12,600. So what I've got is 12,600 plus the 70,000 base, right? The base is going to be the last thing to go. You'd have to get down below 70,000 to take out any of the base because it's LIFO. You guys already know what LIFO is, don't you? Yes.
I'm a little bit lost. Okay. The 82,000. 84,000.
Okay, last year we had 86 in base year dollars.
Okay.
This year we have 82. The total inventory in base year dollars is 4,000 less. I used up some of the most recent purchase. Did I do something wrong?
No, I was just asking that question.
Okay. Does that work? That work?
No.
I mean, what you had is a 70,000 layer.
Yeah.
And then you had another 16,000 layer to make the 86. But the 16,000 layer cost $1.05 each, 105% as much.
Okay.
So it was 16.8 plus the 70, which cost $1 each. This year I only have 82 left. What I did was I took my 95 120 here, I divided it by 116, which gives me 82,000, which is what? What it would have cost in the base year to buy it. So I have 4,000 less inventory in base year dollars. So there's 16 less 4 is 12 left, right? 12 times the 105 is 12.6. So that 16.8 is reduced to 12.6 is all it is. It's gone, and it's gone forever. Yes, sir.
Yeah, just a quick question. Why did you multiply that by 1.05 instead of like 1.6 or 1.16?
Oh, excellent question. I do not have a 116 layer. I don't have a 2012 layer. What I've got is 2010 base layer and some of the 2011 layer left, which is at 105. There is never going to be a layer for 2012. Great question. Yes, sir.
So that initial layer, the 16,800, because of the depletion in 2012, you changed that to 12,600.
And it stays that way.
And you don't use the
You can't get it back. After you sold the inventory, you cannot get it back.
Okay, so the 86, or the 86,800 isn't like relevant. Like it's you.
Oh, no. Yeah, it's gone. So what is our inventory now? What do we have in 2012? 2012 balance sheet inventory, what would it be?
86,800.
It'd be 70,000 from the base year, right, guys?
Yeah.
70,000 from 2010?
Plus 600.
Yes. And 12,600 from 2011 layer. Got it? And how much is that? 82.6. So instead of 86.8, it's 82.6. Got it? Is that working?
Yeah. Yeah, can we interpret it as in 2012, we didn't buy any inventory?
We added none in 2012. We bought inventory, we sold it.
So,
You might have millions of dollars of inventory coming and going, right? Hundreds of thousands at least.
so can we say that now we sold more than we bought?
Yes. Yes, you sold more than you bought. You depleted some, you sold everything you bought this year, right?
Yeah.
LIFO.
Okay.
You sold everything you bought in 2012,
Yeah.
and you sold some of the stuff you bought the year before, right? It's last in, first out. You depleted an inventory layer. Of course you can say that. How much did I sell of the stuff I bought the year before? I sold off 12.6 less 16.8, I guess 4,200 of it, right? More cost of goods sold, less inventory.
Yeah.
You're exactly right.
Yeah, so is there a scenario that you will sell exactly what you bought?
Of course, your inventory would, if you had 86 both years, that's it.
So if that's the case, how are you gonna do the rest of the calculation?
It'd be 0 times nothing is 0. My inventory would be exactly the same in 2 years if it didn't change. It's LIFO. Last in, first out. If you don't increase or decrease your inventory, what happens? It never changes. True? Right, guys? Is that right? No? With FIFO, that would not be true. If you have the same number of units, you're replacing units, right, with different units. With LIFO, if you have the same number of units, you kept the same units, you never sold them, right? It's ridiculous, isn't it? Nobody really does that, but it's how we account for it. Okay, good. All right, let's try the next one. What's 120 into 105.6?
88.
88. I have a new layer of how much? 6,000. I am not going to, just like you were saying, I'm not getting back that layer, right? I can't get back the ones I didn't have, and I'm not going to have any from 2012. There is no 2012 layer, right?
Yeah.
2012 layer is 0, because I didn't add any. So what is it going to be for this layer? What's the index for this year? 120. Take 120, 1.20, 120% of 6. What's that? 7,200? That's my new layer. So what am I going to do? I'm going to add that 7,200 to what I already had the year before. See, if it increases, you can just add it. Make sense? If it decreases, you have to rework things. So what's it going to be at the end? So now I've got these two layers, 2010, 2011. What layer is this? 2013. What's the 2012 layer? There is not one, right?
So the year end would still be 82,600.
No, I'd just add 7,200. Do you want that too?
I mean, for the year end for 2012.
That is what it is. This was 2012. Right? That was 2012. The 2012 consisted of 2010 layer plus a 2011 layer, no 2012 layer. You're right about that, right? That's what the 82.6 is.
Yeah, I was just, like, I
Yeah.
was writing it out.
Yeah, so if I'm gonna do a 2013, what do I have? What's the 2013 balance sheet number? 82.6, right? 70 plus 12.6 plus 7,200. Everybody agree? It takes, you gotta work through a few of these. It'll really pay off. 89.8, and we're there. Got it? Making some sense? So I'm adding those together, all of them. Okay, let's do one more. This is gonna be a good one because they're depleting it, aren't they? What's 100 divided by 1.25? They're going way down. What is it? 80. What's gone, everybody? What's killed off? 80. What do we need to get rid of?
13.
We're getting rid of all of this. This 6 no longer exists, right? Because we had a 6 decline. Whoops, 8 decline. We had an 8,000 decline. So there's 6 of it. It's LIFO, so you're taking the first ones back, right? So it's an 8,000 drop in this thing, right? Okay, between those two. Okay, so we get rid of this 6, and then what do I have left? What did I have left of this one? I had 12, but what is it going to be now? It's going to go down to 10 times 1.05 is what? 10.5. So now what do I have left? I have a 70,000 layer, a 10.5 layer, and that's all. Because I killed off the entire 2013 layer, didn't I? And I killed off part of the 2011 layer. There never was a 2012 layer. So for this year, what do I have? I have the base layer, 70,000. So this is for 2014. I have the base layer of 70,000, right? That's the 2010 layer. It's the base layer. From 2011, what do I have? 10,500. And what is my total inventory, everybody? 80,500. Ta-da. That's what's going to go on my balance sheet. Okay? 2014. And you just keep going, keep rolling. Yes?
I'm sorry, how did you get that 10,500 right there? Like, what did you do?
Okay, I had 12,000 left, right? We had 16, and we used up 4, so we were down to 12. And now this time, so there's 12 there, and then there were 6 more here. So I declined my inventory by 8. See where that came from?
Yep.
Okay, so that 6 is gone, so the whole thing of that one's gone. The 12 now goes down to 10, so it's going from 12.6 down to 10.5 when I take it times 105.
Okay.
Got it? Good. Okay, so these little math games. Now, this seems like an awful lot of work. Somebody made that comment earlier, you know, in the review, like, man, this is a lot of work. Okay, you got 3,000 inventory items, you're a small company. Would you rather do this, subtract 3,000 inventory items, a layer on every single one of them, and add them up, keep perpetual records? No, I'll do this. Sure. So lots of companies still do this. Now, how about if you're a big company and everything's scanned in and scanned out and everything's perpetual record? You don't need this. You don't want it. Now, some of them still do that, but that's true with a lot of things, that old-fashioned ways of doing things, right? Okay.
How do you do LIFO with professional though? How does it keep track of these users?
You're always selling the old ones. You have to keep track of all the layers. Every single purchase, you got to keep track of for each of the inventory items. And when you sell them, you always put the cost of goods sold, the most recent one purchased. You keep the old ones. So you're always rolling back into it. So when you buy something, you have a new layer, right? And then you sell it, it's gone, you know, keep going. Just like when you go back, oh, by the way, on this quiz, can I ask you to do FIFO, LIFO, average, for perpetual and periodic? Average being a weighted weighted average for periodic, perpetual average for, or a moving average for perpetual. Of course they can. Did I ever do that on the chapter 3 quiz? I can't remember if I did it or not. If I didn't, it might show up on this one, or on the test, or on the final. You guys know how to do everything we've ever done, right? You should celebrate if I ask for that. Wouldn't that be nice? I bet you see either on a quiz or the test. You bet. Isn't that part of this? Yeah. You did read this chapter, right? Everybody's read it? No. Anyway, enough on that. So, I bet that convinced you at least to take it seriously, right? Those of you who are even doing it the second time, was that valuable going over it a second time? Yeah, do it a third. Everybody, look at this stuff, look at it. It takes a while to get it down. Like everything that's hard. Everything that's valuable is hard, it just really sucks. But yeah, look over here on page 418, perpetual system. Look at that. And then inventory control with it. Basic methods in inventory valuation. Goods in transit. Consigned goods. Oh. What's a sale with a buyback agreement? It's not a sale. Is it? What's the deal with a sale, a parking transaction? What's a sale with a buyback? I need some sales this year. I need to get rid of the inventory. I need to have the sale. You're a good friend. We do business together a lot. Can I ship you inventory that costs me $100,000? You're going to pay me $150 for it, okay? I want to ship it to you even though you haven't ordered it. What I'm going to do is I'm going to debit accounts receivable, credit sales for $150. I'm going to debit cost of goods sold and credit inventory for $100. I'm going to increase my income by $50,000. When you get a confirmation on a receivable, you're going to sign that you owe it to me. And then you're never going to pay me because you have the right to return it if you don't sell it. What do you think? Acceptable? No. If there's a right to return it, you didn't sell it, it's still your inventory, it's consigned inventory. Put it back in. What would you do if you were the auditor? Reverse the receivable, reverse the sale, debit the sale, credit the receivable, debit the inventory, because it's now our inventory, not theirs, right? And credit cost of goods sold, and it never happened. What if you don't catch it? Oh, well, they did income by $50,000. Got it? Collusion. If you're a bad person doing it, you need a bad person too, right? Colgate, all of it, got in big trouble. You're in town on that kind of stuff. Agreements to make things look like they met their sales quotas, right? They got their bonuses. Big companies, right? Big companies. People do amazing things, right? So, anyway. So what about a sale with a buyback agreement? Now, sale with a high rate of return. How about if you can return stuff? My wife buys a lot of stuff at Nordstrom's because she likes spending a lot of money for stuff. No, well, it is expensive, but it's really good stuff. She buys me polo shirts and stuff from Nordstrom's, and they last 2 or 3 times as long as if you buy them from other places. They also cost double, right? But it's really good stuff, right? They're really well made. And you know what? If something's wrong with something that they buy and sell to you, what do? They take it back. They made their reputation this way. They started in Seattle, Washington. And they're still headquartered there, I think. They sell shoes to people, and people actually take the shoes and wear them out and return them to them and get new shoes. Because they're just kind of jerks, right? Customers. But their thing is, if anything goes wrong with the product we sold you, we will give you a new one, or we will give you your money back. She buys stuff from them all the time, and she just, oh, I don't think I like that. They pay the freight both ways, to her and back. No wonder it costs so much, huh? Oh, they don't have the stores everywhere. They have very many Nordstrom stores, and people buy lots of stuff from them. If you've ever been to one of their stores, right? Okay, if you haven't tried Nordstrom's yet, you ought to. Really good company, really very good company. Anyway, but it's expensive, but you're getting really good value. And they guarantee the thing. Do they have a high rate of return? Yes, but what they do is they estimate how much is going to be returned, and they have a track record of doing that. So what you do is, you know how you have a allowance for doubtful accounts? Debit bad debt expense, credit allowance for doubtful accounts? What they do is they debit sales returns and allowances and credit allowance for sales returns and allowances. Sounds strange, doesn't it? but that's a reduction of their receivable and therefore also a reduction of their sale. Imagine what if you did this. You debit accounts receivable when you sell it, right? Or cash, and you credit sales. Okay? And let's say this is for $100,000, you know, in a period. Which then it's a lot more than that. Okay? 100,000. Okay? And then what you do is you debit bad debt expense for the portion that receivable you expect never to get, right? Maybe that would be 2,000. Let's say we have 2% bad debt experience across our sales. And this would be allowance for doubtful accounts. What you've done is you've reduced your receivable down to 98,000, that receivable, haven't you? And you've reduced your income down by 2,000 of the expense, right? Matched it up with when you had sales revenue. Okay, let's say that they estimated that 10,000 of that's going to be returned. Okay, pretty high returns. What would you do? You could credit account. You could credit allowance for sales returns and allowances. Sounds ridiculous. Another contra account, and I put the 10 grand in there, and I debit 10,000. I'm not going to reduce the sale because it's not reducing my sale, it's getting stuff returned to me, right? I want to keep track of how much it is. It's reducing my net sales, though. This is going to be sales, returns, and allowances, just like I had given them a return or an allowance, right? Just like I'd given them the credit. Then when somebody returns something to me, I don't go to sales, returns, and allowances with it. I go to allowance for sales, returns, and allowances. Make sense? When they return the product to me. And on my income statement, it'd be sales, less sales, returns, and allowances, and less sales discounts is my net sales. That work okay? So you can have those sorts of things. High rates of return you need to be really careful with. If the rate of, if your rate of return is really way too high, you wait to record the sale until you're done having a return. There's also, if the probability of collection is real low, we'll do that later. If the probability of collection is real low, you might not record the sale because of that too. Okay? If you're never going to collect the money, is it realizable? No. No. So then don't record the sale. Don't record the receivable. It's not a receivable. They're not going to pay you. I guess you just gave them the product, huh? And sometimes people do stuff like that. I have a product they can't get rid of, and I convince somebody to take it. Maybe they'll pay me, maybe they won't, you know, that kind of thing. So, yeah, here's those kinds of things. So, we did some of this understated, overstated, and we'll get one of them kind of things. You know the difference between product cost and period cost? Product is what? The inventory itself, which would include what? The purchase cost of the inventory, if I'm manufacturing it myself, what? Materials, labor, overhead, right? Added up. Those are product costs, right? Also included in the inventory cost is any freight in. Have you bought stuff online, right? Okay? When you buy stuff online, sometimes you pay for the freight, sometimes you don't. What do you really pay for the product? The purchase price of the product plus the freight. If you're comparing two places and one pays the freight and the other one you pay the freight, you know, so I'm buying a shirt online. I've never done that in my life. My wife does all the time. Okay. I do not dress myself. So, you know, I like it when people compliment me on something I'm wearing sometimes. I get dressed up and stuff and say, yeah, my wife has good taste. Except for she married me. But otherwise, yeah. Okay, anyway, but yeah. I did that with Brad Stevenson. His wife picked a really nice restaurant. I said, your wife has good taste, and you know what he did? I didn't take the opportunity to say your wife has good taste except in men. And guess what he responded with? Yes, she does. She married me. Yeah, so anyway, I passed an opportunity and, you know, lost on it. Anyway, so it was Veronese. It was a good restaurant. Oh, no, that was the Uptown. We've been eating good places lately with these guys coming to visit. Nice. Thank you, you guys. Your tuition dollars are working in. Lunches, dinners. Anyway, what was I talking about? Okay. So either way, if I was going to buy a shirt, and the shirt's $20 in one place and it's $18 in the other, but the one that's $18 charges me $5 freight, what do I think? I think that's $23, and the other one's $20. I'm going for the 20, right? It's no difference here. You pick up all the costs, taxes, duties, right? freight in, freight that you have to pay, you look at all that stuff and you make sure it's included. How about if you're building inventory item that takes a long time to build, like a house, right? You're building a house, you're a builder, you're building a house. The interest cost during the period of construction is part of the inventory. Got it? What about after it's finished and it's ready to sell? Now that's interest expense. You gotta cut it off, you gotta separate those things, okay? Same thing if you're building the building for yourself. You capitalize the interest, what does capitalize mean? Record an asset, right? What's expense the interest mean? Expensive, right, in the current period. Oh, what's a period cost? And those are product costs, period costs. Costs incurred in the period, right? So where would marketing be? Where would accounting expenses be? Where would research and development be? Where would payroll costs be, for the human resources? Where would it be? All those are operating expenses, right? Which are period costs. Everybody got it? Don't look so excited about this. I know you already know this stuff, but I hope so. Oh, treatment of purchase discounts. You remember I did sales discounts with you guys? I did that for you, didn't I? And when I did sales discounts, and it was real easy because I wanted something easy to do that day, I guess, so I did it, right? We did sales discounts, gross and net. Guess what? Purchase discounts is the mirror image of it. Look at it. What if I give you one of these? You will celebrate because they're so easy. Okay? What do people usually do? On sales discounts, what do people tend to do? Do you want to know how much sales discount you're giving to people, or do you want to know how much sales discounts they did not take, that they could have taken? We usually want to know how much we gave them because it's a cost to us. So which method do we use? Gross or net? Which one shows us the sales discounts that were taken? No, it's the gross. It's the gross. What does gross do on sales discounts? You record the gross amount, and then when they pay you less, you record a sales discount. Right? The net, it's buried. The only time you find out is what? When they don't take the discount, you'd have a sales discounts not taken as an additional revenue account, right? What about on the purchase side? On the gross, you would be able to see all of the purchase discounts you took, which would make you feel good, right? You negotiated for and you got them. But that's not what you really care about. What do you really care about? When you don't take one, you are throwing away profitability, right? We went through this, remember? Okay? So what I would use is the net. So most companies use net for purchases and they use gross for sales. The majority of companies, okay? And by the way, I keep track of both anyway. I do it informally, not the financials. Okay, fine. Okay, you know what, one that we haven't really talked about too much is specific identification. There's so much to talk about. Specific identification inventory. We did talk earlier when we were doing chapter 3 about perpetual and periodic, how to account for them. Went through that. You read this and think about it again. Okay? And I told you to get ready for it on that quiz. I don't think I put it on the quiz or test today. 1, 2, 3. I don't know. You guys don't remember. Go back and look at them if I did. It's fair game again, of course. What's specific identification instead of an average cost or FIFO or LIFO? We got perpetual and periodic. What's a specific identification thing? How about if I'm selling Rolls Royces? Or I'm selling diamonds that cost $200,000 on average? You think you might use specific identification? You know, I'm selling 747s. They still make those, whatever Boeing thinks that is, right? I'm selling jet aircraft. I'm Boeing or Airbus. Every single one of them is different, right? Think I might use specific identification? Yes. What does it mean? I keep track of each individual inventory item. Every diamond I keep track of, right? They all have different costs. They all have different sales prices. I want to make sure when I record the cost of goods sold, I record the one I sold. That's all it is. So is that more accurate, or is FIFO or LIFO or some sort of average? I think it's more accurate, but what's really interesting about it is I think it is more amenable to manipulation. Warehouse is a huge, you guys know who warehouse is? You see their boxes, they're paper, and it says Weyerhaeuser on it. It's green with Weyerhaeuser across it, and it's green for trees, right? They say they're the tree growing company. Well, they do grow a lot of trees, but they also cut down a lot of trees, right? They're the tree slashing company too, right? They make paper products, they make wood products, of course. They own a significant portion of the United States land. Back in the 1930s, they bought up a whole bunch of land that people, were going bankrupt, and they had money and they could borrow money, and they acquired a whole bunch of property back in the Depression era, right? And they still own it, and it has stands of timber on it. They can cut that timber whenever they want. Specific identification. When they cut that timber, what do you think their cost is going to be compared to timber they buy right now? Because they can buy, if you own a piece of land, they can buy the timber off of your land. You come and take out the timber, right? And then, you own the land, it's clear, right? It's not their land, it's yours. So they can do that. Which one do you think is more expensive? The timber they buy from him now, or timber they bought in the 1930s? Which has a higher cost? Yeah, it's historical cost. It's capped, generally accepted accounting principles. Of course it uses historical cost. And it's specific identification. Isn't that the best? Well, if it's diamonds, yes. If it's timber, maybe not. Because here's what they do. If their income's not quite high enough in the last month, they cut some of their own timber. The cost is almost nothing. The sales price is still the same. They make a fortune on that, and their income bumps up. What if their income is too high? They want to keep their income kind of going up gradually, to keep your beta real low. You don't want big peaks and valleys in your earnings, do you? They don't have any. They don't have to have any. Because what they'll do then is they won't cut any of their own timber. They'll only cut new timber. They have to pay a fortune for them. They don't make hardly anything on that. Got it? And they are following probably the best gap for accounting for inventory, aren't they? This is problematic, isn't it? It's really tough. There's no way to stop it, right? Because they're telling the truth. It's what they did, right? Okay? It's an interesting company, and they're good in their math. They actually do plant lots and lots of trees, and they grow and stuff, and they also rip people off, and they got rich by stealing land from people, and all this historical stuff. It's like Volkswagen, right? Poor Volkswagen. In the Holocaust, we had people making Volkswagens who were going to the bastards. Right? Wow, what a history for a company. And then they become a really good company, do a whole lot of really good things, it looks like, and then what do they just do? Maybe half the smog in London is due to their Volkswagen diesels. That's an estimate, it's real. They intentionally kill people. People with asthma are dying. Wow! How does this happen in a big company? When we talk about ethics, you guys, when you go out there and you're making decisions in your companies, think about what you are doing, right? Wow! How could this happen? How could anybody be on the board of directors? How could anybody be one of the officers at Volkswagen? Everybody knew. And they just found out what? Did you see yesterday? Audis, Porsches, they're diesel engines too. Same thing. Yeah. And what's going to happen to Volkswagen, seeing as they are by far the largest employer in Germany?
Can I protect?
Nothing.
Protect?
Nothing. Wow. So, did they make a lot of money doing it? They were becoming the largest car company in the world again. They're not going to be anymore, I don't think. So, I guess all you can do is never buy one. But then my wife just sent me a thing today that Mercedes is recalling a whole bunch of vehicles because they have a problem. I saw an email from her. I don't know, what do you do? By the way, do people make mistakes? Do you unintentionally screw up?
Yeah.
I mean, you ever make a mistake? Everybody. So good companies make big mistakes. Yeah. With General Motors, was it intentional when they had those defective ignitions? No. Was it intentional when they kept using them after they knew it was defective? Ugly, isn't it? Really ugly. Still hurt them. Right? Still hurt them. But anyway. I guess you have to drive something. So anyway, specific identification is kind of neat. You can do average, FIFO, LIFO on your own, absolutely. Let's talk about LIFO reserve real quick. Over on page 432 and 433. You need to really get a handle on this LIFO reserve. You guys do know that in order to use LIFO for tax purposes, you must use it for financial statement purposes, right?
Yeah.
We have a way around it. This is a way around it. We do use LIFO for financial statement purposes. Most companies that have inventories of any substantial size use LIFO. Why do they do that? Because the costs are increasing, their inventory will be less, right, on their balance sheet with LIFO, with FIFO. Also then on their tax return. They don't care about that. They don't like that even. What do they like? If your inventory goes down, what goes up? What was it? Cost of goods sold. Yeah, cost of goods sold goes up, right? What you start with plus what you buy is what you have. Beginning inventory plus purchases is available, right? Subtract the ending inventory as cost of goods sold. What if you make the ending inventory less? Cost of goods sold goes up. If you make the cost of goods sold go up, what goes down? Net income. Our taxable income goes down, I pay less tax. I save tax dollars. How much tax dollars saved across the economy? On page. What page was that on? I thought it was. Is it right there somewhere? The LIFO. I just saw it. I lost it.
445.
445, thanks. Yeah, page 45, there it is, repeal LIFO. On page 445, what does it say there? $61 billion, and this was in January of 2009. $61 billion in uncollected taxes. If everybody had to switch to FIFO, couldn't use LIFO anymore, there's $61 billion in deferred income taxes that could get paid. Now, you know what? They can change they can change the tax law and say that you can use LIFO even though you don't use it in your financial statements if they wanted, and then they would never collect that money, right? That's really the solution. And we'd start using FIFO for financial statement purposes, right? We can make the change. You just have deferred income tax on it, right? That's all. Okay, but those taxes have been put off. How do we get around using FIFO, kind of get around, using FIFO, or LIFO rather, for our financial statements, and have people know what FIFO really is? What page was I on? Page 433 again. Okay? What's the deal here? What's going on? The LIFO reserve. What we do is we keep our inventory at FIFO for our purposes for running our company, which makes more sense because first in, first out, it's more likely that's what we do, right? We get rid of the old stuff first and keep the new stuff. True? So we account for it that way for internal purposes, and then we compute what inventory would have been if we had been using LIFO. So we can put LIFO in our financial statement. And we make a journal entry. Look at the journal entry on the top of page 433. We debit cost of goods sold and credit allowance to reduce the LIFO. That increases our cost of goods sold and it reduces our inventory. You see that? We have disclosed inventory at LIFO, and we've disclosed cost of goods sold as though we were doing the LIFO, net income as though we're doing a LIFO. Got the idea? So we follow generally accepted accounting principles. But what can somebody do when they look at the notes to the financial statements? Take a look at American Maize products. At December 31st, 31,516,000 inventories were valued at LIFO. That is less than corresponding replacement of 3,765. So what are they doing? They're giving an idea of what FIFO would have been. So could you adjust the inventory up and your cost of goods sold down, and therefore your net income up? Yes. Got it? You have to split it between years though, because it's really only the change in the current year, right? Because that allowance, the allowance to reduce inventory to LIFO is what kind of an account do you think? It's going to be inventory less that allowance. What kind of an account is that thing? Contra asset, yeah. Do you close that one? No. Right? You don't close that one. You close cost of goods sold, of course you do, right? So that one's going to be sitting there. So here's the deal and the problem I might give you, probably will sometime. Only adjust the allowance from where it is to where it should be. Don't put in the whole allowance again, there's already a balance in the allowance. So if the allowance was 30,000 like it is in their little example here, what if it needs to be 45 now? Well, then credit it for 15 and debit cost of goods sold for 15. That's the current year effect. What if the allowance only needs to be 30 now? Or I'm sorry, only needs to be 25 now and it's 30 on the books. It needs to be 25 now. What would you do? Debit it for 5 and credit what? Cost of goods sold. Got it? It's the change in the allowance that's going to determine it. And then you can take a look at Brown Shoe there. They say the same thing. Inventory is about a lower cost or market, principally by the LIFO method. If the first in, first out method being used, inventories would have been 11,709 higher in the current year and 13,424 higher in the previous year. What are they telling everybody? That's how much our income would have been higher by each year. Inventory higher, total assets higher, right? Got the idea? And our income higher. Both years. Got it? Okay. So, it's gaps. It's okay. What is LIFO liquidation on the next page? What do you think? Getting rid of layers of LIFO. What did we just do with the dollar value LIFO? We looked at LIFO liquidation. But if you're keeping track of each individual inventory item, what is it? I'm depleting those old layers. What happens to you when you have LIFO liquidation? Your cost of goods sold or what? It's just like I said on the warehousing thing. They're doing it on purpose, right? But what happens if, let's say I adopt just-in-time inventory. I have 100,000 items of an inventory and I'm going to drop it down to, say, 40,000 items, right? I'm going to get rid of 60 of them. What's going to happen if I'm LIFO? Layer after layer after layer is going to peel off, isn't it? Those old layers are going to disappear. Where are they going? The cost of goods sold. And they are progressively lower and lower and lower cost of goods sold, which means what? More and more and more net income, right? And therefore more and more and more what? Tax. So what's the rub of adopting just in time? Of getting your inventories under control, of lowering your inventories down? You got to pay the tax. What happens if your product goes obsolete and you have to get rid of it all, sell it all? Oh well, right? Get rid of it as fast as you can. You're having profit even though you're losing money. You got the idea? You always recommend to your clients use LIFO because it'll save them tax dollars. It doesn't forever save them. It saves them for now. You guys just did present values. Would you rather pay tax now or 10 years from now? 10 years, obviously. Who in their right mind wouldn't do that? So of course you use LIFO. But what should you do? Make sure you keep the resources available, not only in cash, but I mean resources available, credit capacity, available to do what? Pay the tax when it's due. And when is the tax most likely to come due? When things are going haywire. Not when things are good. Got it? Your product became obsolete, you're having to change things, you're scrambling, right? And now you got to pay taxes, right? Not a good deal. But it is a good deal because you didn't have to pay it earlier. Now you're paying it much later. Just make sure you're stable so you can do that. And I've had a number of clients not do that. They're just, no, we're making all kinds of money, and that's never going to change. And, you know, boom, bottom falls out. I'm like, well, wait a minute, I have negative cash flow and I owe taxes? And yeah, that's right. Not a good situation to be in. So, but we knew it was coming, maybe. Could have that problem. Okay, good. Let's take a real quick look at, read through all this stuff, LIFO, FIFO, average. Major advantages of LIFO. What's the real major advantage of LIFO? Tax benefit and improved cash flow. Page 441, oh yeah, big. What do we mean improved cash flow? I don't pay the taxes, I have more cash. Matching, maybe. What does matching mean? My cost of goods sold on my income statement will be more recent costs, which maybe gives a better reflection of what the future looks like when I buy something to replace it and sell it, right? So there's some legitimacy to that. Maybe my income statement's a little better, but what do you think about your balance sheet? Oh my, you're getting older and older and older costs. What do you think my preference is? When we did allowance for doubtful accounts, I talked about this. What is my preference? If I have a problem where I have to make a compromise between the balance sheet and the income statement, that was between bad debt expense allowance for doubtful accounts, right? Which account am I more interested in having really correct? Allowance for doubtful accounts or bad debt expense? which one do I get to close to retain earnings? Bad debt expense, and I get to start over. What happens with allowance for doubtful accounts if I leave a mistake in it, or I leave an error in it, or I leave an estimate I don't like very well, is what it really is, in that account? Still there next year, huh? Still gotta deal with it again. This is the same way. This is the same way. So what do you think on this thing? With LIFO, what's happening? Maybe your income statement's a little better each year, right? You're a little more conservative, maybe, right? Showing less income as prices are going up, more recent costs and cost of goods sold. But what's happening to your balance sheet? It's getting further and further and further away from economic reality, isn't it? Weyerhaeuser has trees they bought in the 1930s, right? Land with those trees sitting on it. The land's one asset, the trees are another asset, but they're not, right? They are, okay? Timberlands. So what do you think? It's getting worse and worse, isn't it? Every year that goes by, right? So I don't like LIFO very well for financial statements, but I do like it a lot for tax purposes. Okay, future earnings hedge. Oh man, you know what they're saying? You can smooth with it. That's it, isn't it? They don't call it smoothing, but it kind of is, isn't it? Oh, it's a future earnings hedge. I don't have enough earnings. Oh, well, I'll have more earnings later when I don't have enough. And then when I have too much, I won't have as much. Good deal. Yeah, I don't like that. Okay. Disadvantage of LIFO, it reduces your earnings, makes you look like things are awful. Inventory is understated probably. It does not match the physical flow. And inventory liquidation, poor buying habits with LIFO, right? If I don't, yeah, I might buy more than I need to avoid inventory liquidation. Keep more inventory around than I need to make my income statement look better. What do you think of that one? How would you feel if you're a stockholder and your employees are buying more to make the financial statements look better? The manager, oh my, that's ridiculous, right? So anyway, all right.
Without the future earnings hedge, can you explain it again, please?
Okay, what the deal is when things start going haywire for you, right? The value's going down in the product later, perhaps, right? You have economic difficulties, your product's becoming obsolete. The cost of goods sold will be low as the sales price goes down, which might make you look a little better. But the other thing that you could do is what I just mentioned on Weyerhaeuser, for instance, a company like that, they could voluntarily make their income more or less, right? All you got to do is determine which, that specific identification, you could do it with that, right? You can't do it with LIFO or LIFO. With LIFO or LIFO, you got to go with, okay? But it might protect you, right, later. Because you are under-reporting income in the earlier years, you might get to over-report income in later years. What do you think of that, guys? That's kind of what LIFO does, huh? Your income is reported at less than it would be under FIFO. And then later, when you sell the inventory, you'd report it higher than you would, right, with FIFO. When you deplete those LIFO layers, you have more income, right, than you would have otherwise. That's what they're talking about. Make sense? Does that kind of do it? Okay. All right. We got a few more minutes. Let's do one more just to sort of bring back. Let's do this. On inventory errors. Did we do 812, you guys, that were here earlier? We did, right? Exercise 812 on page 455. Be sure you work through that. We also did 810. Did we do 811? We didn't, did we? Let's do 811. We got 7 minutes, huh? Here we go. Let's do exercise 811. I really like these kinds of problems where there's an error. Oh, by the way, on the other one, for instance, exercise 812, what's the key thing? The ending inventory of one period is the beginning inventory of the next. right? If you have an overstatement or understatement in one period in income, it's going to generate just the opposite in the next period. They're going to be correcting, right? If you have a string of years like they do here, and the beginning, there's nothing wrong, and at the end, there's nothing wrong, all those years added together are correct in total, but each year is screwed up, right? And in this problem, what it looks like is the income is gradually going up. If you look at that one, it's going up, what, $2,000 a year? It's a classic example of smoothing. It's going up exactly $2,000 every year. We worked through the first 4 of those, didn't we? And what was happening to the income? Bouncing up and down. What would happen to their beta if they do this smoothing? It's lower. Their cost of capital is lower. Cost of debt's lower. Cost of equity is lower. Cost of capital is lower, right? Because they're more stable. Are they really? No, they're manipulating their income by messing with their inventory. Or it could be accidental, of course, but that's quite a trend, isn't it? I know that doesn't look accidental, that looks intentional, right? And there's some probability that would happen. So let's try it at 11. Stacy Mill Corporation reported current assets of $370, current liabilities of $200. Following items have been incorrectly recorded. Compute the current ratio based on their balance sheet. Recompute the current ratio after each one. What we really want to do here is what's the impact of these errors, okay? So if I had current assets of $370, and I had current liabilities of $200, what is that? That's my current ratio, right, guys? Current ratio is current assets minus current liabilities, right? Working capital is current assets minus current liabilities. What is that? What's 370 divided by 200? 1.85. 1.85 to 1 is my current ratio, right? Good. Okay. Goods purchased costing $22,000 were shipped FOB shipping point by a supplier on December 28th. They received and recorded the invoice on December 29th, but the goods were not included in the ending inventory because they were not received until January 4th. How were they shipped, you guys? Whose inventory are they? Am I buying them or selling them? I'm buying them, so they're mine. What if I was selling them? They'd be my customers, right? What does FOB shipping point mean? Free on board, right? It means a title transfer. Who's going to pay the freight? Whoever owns it. Who's going to insure it? Whoever owns it. Got it? That's what's going on. Okay, so what would this one do? What should they do? They were not included in the count. So what should they do? Should they be included? Yeah. So now what's my current assets? But what's my journal entry to fix this? My current liabilities are going to be what? 200. Why? What's my journal entry to fix it, everybody? Debit, inventory, and credit what? Debit inventory for 22,000? Credit what for 22? Where would it come from? Does it go to accounts payable? What does it say they did? They recorded it already, didn't they? They just failed to count them. So here we go. Purchases? I thought they recorded it. They just didn't count them. Be sure and look at the video we did, you guys, because we really beat this to death, didn't we? Right? We did a bunch of these, and they're hard. Okay, what's the deal with this? The inventory should be 22 higher, all right? And liabilities are okay because they recorded the invoice, didn't they? Let's do cost of goods sold. This is how you do all of them. And it really pays to write all this down. It really does. It's faster, actually, I've discovered. We get ourselves confused kind of otherwise. Okay, that's cost of goods sold, right? It's going to go up there as one of the expenses. Beginning inventory is probably okay, right? Didn't say anything. Purchases are okay because they said they recorded it. They debited purchase in credit accounts payable. Is available okay? Yes. What's wrong? Ending inventory is 22 too low. And what did that cause to happen? Cost of goods sold is too high by 22. So cost of goods sold is too high by 22, revenues are okay if they didn't say anything. That makes net income too low by 22, right guys? Which means equity is the asset too high or too low? Did I lie? No, the assets are too low. I'm going to increase them. The assets are too, I said increase. The assets are too low by 22 right now. And the equity is too low by 22 because the net income's too low. That's the thought process, okay? So what's my journal entry? Debit inventory to increase this, and credit what? Cost of goods sold, got it. Okay, it's too high. Or that's assuming that this was periodic and they use a cost of goods sold account. If they don't use a cost of goods sold account, you go to income summary. Right? Okay? Let's try a second one. See if we can get another one done. Goods purchased costing $15,000 were shipped FOB destination by a supplier on December 26th. They received and recorded the invoice on December 31st, but the goods were not included in the inventory because they weren't received. What do you think of that one? Should they be in inventory? Oh, by the way, what is that number? I should have done that. 392 divided by 200, because we'd increase our current assets, right, by 22, but we would not change our current liabilities. 1.92, so that's what they wanted to do in the problem, 1.96, okay? All right, on this next one, what do you think of that one? What do you think, guys, on number 2 there? Should they be included in the physical count? No, so that's okay. But what about they were shipped to you? It's FOB destination, they're still there, it's not yours, but what did we do? We recorded the invoice. So what have we done? We debited purchases, didn't we? For 15,000, and we credited what for 15,000? Accounts payable, right? See you later. Should we have done that? No, we don't have the purchase, we don't have the account payable. So what happened, you guys? Let's do the same thing over here. What do we have? Because how do we fix this, by the way? It's real simple. That's what they did. How do you fix it? Just flip it, reverse it. Sure, absolutely. What I would do is I would debit accounts payable for 15. I'm not kidding. And credit purchases. Get rid of it for 15. Wouldn't you guys? Isn't that my adjusting entry? Just reverse it. They should not have recorded it, true? Okay, now what? What do I think happened here? Is my inventory screwed up? They should not have counted, and they did not. What do you think? No. Nothing's wrong. My liability screwed up. I have too much liability, don't I? They're overstated by 15. Am I right? Aren't liabilities overstated by 15? They credited liability and should not have. What else is wrong? Okay. Beginning is fine. Purchases is too high by 15, isn't it? Everybody agree? What does that make available? Too high by 15. How about ending inventory? It's okay. They counted it right, didn't they? What's wrong? Cost of goods sold is too high by 15, isn't it? You guys agree with that? Cost of goods sold is too high by 15. What's wrong with net income? It's too low by 15. What does that do to equity? It makes it too low by 15. And I've got my answer, don't I? Wow. Easy, isn't it? Okay, if you just discipline yourself to think through them. Okay, what does that do to current assets and current liabilities? And they wanted each one to be independent, I think. So what does that make it? We started at 370. What happened to my inventory? Nothing. So it's still 370. Would everybody agree with that? What about my liabilities, though? They're 200, but what do I think? They're too high? I should credit them, or debit them rather, by 15. So what are they now? 185. So what would be your new current ratio? 370 divided by 185. Is that 2.0? I don't know. You got the idea what you need to do? Walk through these, and I think you don't have to do it that way. You can do it all in your head if you want, right? But you get stopped, right? Thanks for hanging in there. No, I don't know. He's working, working, working.